All right, folks. It's been a minute since I've used OBS. I had an old intro splash welcome screen that just flashed across there, so something about losing my voice or whatnot. I don't know, but the delay was due to my wife giving me the wrong time. I had to take my youngest son to a dentist appointment. I thought I had time to do it right before I had to leave. My understanding was that he had a dentist appointment at 11, and she told me, last minute, right after I invited you all to a live stream, she said, "Oh, you got to be there at 10 o'clock." And I was like, "Oh, well, that's nice." So I can't complain and say, but I just scheduled a live stream because I'm supposed to be on break, right? Anyway. All right, so I'm showing my entire screen here, okay, for the purposes of understanding what it is that I do when I teach. Also show you some things about this morning's price action. I was watching it from my phone while my son was in the dentist office, and I was watching to see if we could get that 16,208.50. That was the initial draw. I mentioned that this morning on my YouTube community post, so you can see that there. I just realized I don't know if you can hear me. Yeah, I don't know. Let me see. Bear with me 1 second. This is like a casual live stream, so it's not going to be all that formal. So if I do things that's going to be annoying to you, go watch somebody else. I'm not charging you to be here, but give me a second here. All right, so I'm going to see how long of a delay this is. I'm listening to it on my phone, so. I hear some sound, so that's good. All right, so I'm going to see how long of a delay this is. All right, so that's about 20 seconds delay. So it don't matter because we're not doing anything here on the fly where you have to be following along second by second anyway. But let me welcome you back. Hope you're doing well. It is a good morning. Sent you a little, I don't know what you would call that, little short video showing my house this morning. We woke up and, well, let me rephrase that. ICT woke up and took the puppies out back, and when I opened up the door, I saw the snow on the ground. I was like, "What just happened?" I was not expecting that. Pleasantly surprised. So, figured I'd share that with everyone. They all like to see those personal things from my personal life. I'm gonna not be showing you everything that most of you ask to see, but every now and then when it's something nice like that, I think it's I thought it was pretty. But anyway, this morning I was looking at the index futures market, and let me get this stuff off here. Okay, as I mentioned for the folks that just joined us, I'm showing the entire screen so that way you can see, yes, look right down here, folks. You see that right there? That says paper trading. Okay, for the folks that constantly keep posting in my community, not my community, but the comment section, every video is open for you to leave a comment. Okay, and the reason why I have it like that is it's for me to read it. You're welcome to post whatever you want to post, and that's fine. But I can see your questions, and some of those things are very helpful to me. So, and a lot of my mentorship students, they will post questions in there as well. So I use that as a means of coming back into another lecture, or I'll touch on something that maybe a student needed more insight on, or maybe a topic. But mostly it is like a sugar fest in there. It's like, I love you, ICT, and thank you so much for, and I appreciate all that, but it just seems like they look artificial if I let them post. And so that was the reason why I kept it hidden all the time before. So yes, I see all your posts. Okay, you can stop putting the test comment or the fellas that are, or oh yeah, paper trading, laugh out loud. So let me do this again for the people that are slow in understanding or brand new. I am in the United States, and I am not a registered trade advisor. That means I'm not a CTA. I'm not a financial advisor. So when I talk about price action and I openly share it in the context as a paper trade or a demo, that gives me protection. Okay, you can't use this as investment advice, because any execution I'm showing while I'm teaching, okay, yes, you can look on this YouTube channel and you can see live trade executions. They were cleared through AMP Global Futures. That was the brokerage firm. I'm not representing them. I'm not asking you to join them. I'm not saying they're the best broker. I had problems with them. They fixed that problem, but every broker out there has their own little quirky things, and some of them are worse than others, okay? So I'm not going to tell you to put money in AMP, but for the folks that say that there's no executions with a live account, it is a lie. You can see that on this YouTube channel, okay? But when I'm teaching, when I'm talking about something, when I'm pointing out something in advance, I'm always doing that in the medium of a paper trading account. The reason why I do that, for the folks that don't understand this, okay, there is a thing called pumping and dumping. I can never be accused of anything like that, because if I talk about something in advance, I'm only showing you those examples with a demo account, because I'm not trying to get the audience size that I have behind a price move and then me exit early, and then I get to make money and everybody else doesn't. And there's been people caught doing things like that, which is unfortunate, okay? But I don't do those types of things. And because I'm not licensed to give trade advice, when we're talking about price action and I'm teaching through the medium of a paper trading account, okay, just like when I was teaching Forex predominantly, I was using a demo account. That protects me in the United States, because I'm not operating as a analyst / trade advisor, financial guru that you're doing everything I tell you to do with your money. I don't do that, okay? So what we do is we study price action. I point out the specific things, but I'm doing it in the context of live market price. It's not delayed, okay? And I'm going to show you the difference between market replay. I meant to do this the other day when I was doing the example. I forgot what I was talking about, but I said I was going to show you the difference between market replay and a live execution, and how you can see the difference when I'm showing examples. For the fellows from India that keep saying that this is market replay, when you do market replay, this little button up here, this little thing that says market open, that changes to, see that? I've activated market replay. This doesn't show market open. It's not a green little button anymore, okay? And also, you have to do all of your buying and selling down here. So for the sake of saying, we're going to look at this example here. I promise you we're going to look at some things that are more pertinent and more useful, but it's important that some of you see this, because these things keep repeating in the comment section, and it's because of ignorance, not because that you're stupid. It just means that you just simply don't know, okay? And I'm going to show you the difference. So whenever you highlight a chart, wherever you see a point of reference where you want to have something you want to study. I really never use market replay. This is probably the only second time doing it to show you the compare and contrast of what it is I actually do versus what is actually occurring. Now, right away, if you look at what I've done here, I've put the market replay on, and you can see the little player button down here. If you click play, all the candles start moving, and they do not have a countdown to close function or a little window that pops over here in the right-hand side of the price axis. That countdown to close, that's occurring when I'm using live data. In all of my examples, it's always live data. And notice what's occurring also here. You see what time that is? And look at the time down here. It's 10:30. Well, we're way past that. The time down here in the lower right-hand corner is 11:45. I'm always using New York local time. So whether you're in Uganda or Greenland or California, USA, wherever you're at, if you're trying to follow my concepts or the things that I've taught, your trading view time frame or the time zone for your data must be in New York time. If you do that, everything matches with my lessons. The folks that want to use their local time, that messes up everything. Okay, so when we look at things like this and all of this price run here, I'm going to cover all that too, by the way. So in case you're looking at this thinking I'm not here to try to learn market replay, this is just to teach the folks that are ignorant, they have no idea what they're talking about. If I'm going to do a market replay trade, okay, and I'm going to only be able to do that if I use these two buttons down here. When you watch my examples, this is not blue. It is not showing you market replay paused. It's showing you market open. This over here, I'm sorry, I forgot what I was going to say here. Oh, the buttons for buying and selling, they're not there now. When I'm executing my examples, or if I'm taking partials, that is the reason why I use that clunky little hot button up there, okay? It's not that I don't know how to use limit orders, because clearly I've shown examples of that as well, both in a demo account, paper trading account, and a live AMP account with real money. And for the folks that say that when I'm showing an AMP account, they're saying that that's an AMP demo account. Hook up a demo account from AMP, and you're never going to see AMP Live show up down here. It never happens, folks. Okay, so you really need to do some homework and stop listening to dumbasses on the internet, because that's what you're listening to, and you're lazy and you don't want to just see for yourself what it looks like if that's really what it is I'm trying to do. So there's a discrepancy if I'm using market replay between these two times. They won't ever match. Notice that? And this is always the green market open, showing you that it is not using market replay. Okay. There's also another distinguishing characteristic that when you see the executions, let me change this to that. Okay, and say we're watching price. Okay, notice how the candlestick doesn't show any fluctuations at all. It's just, it appears and that's it. There's no up and down within the same candlestick. So when it does that, it's like wooden and stilted. It doesn't give you the dynamic fluctuations that live price action will show within a 1 minute candlestick. So because that is not having a countdown little timer here saying how many seconds it is till the candle closes and a new candle starts, that tells you right away that this is not market replay when I'm showing you that. 2, the time always matches in the lower right hand corner. That's the reason why when you see my examples, even though they're sped up many times, I'm clicking on the time windows. You can see I'm literally clicking on New York time, and you can see that the times match. And then I'll hover over top of a candlestick, and the candlesticks will always match. And for the folks that try to say that this is me rigging TradingView, I've openly told TradingView, who follows me on social media, to come out and tell everybody that what I'm doing is fake if it's not being truthfully done. It's simple, folks. It's very simple. I don't need to pretend. Okay, it's very important that you understand that. So now notice how the market replay ended, and that turns right back into what? The little button that says market open. Okay, so the difference between, say, the idea of using the information that I just showed here and showing the difference between what a market live execution looks like, okay, with real-time data, not delayed, not using market replay, versus that of a market replay execution. And we're going to do that again real quick. I've highlighted market replay. That little open button turns, it ain't green, it ain't showing you anything. There's no D up in here showing it's delayed data. So if I'm going to look at this little segment of price action right in here, there's the segment of price action. We're going to click play, and we're going to do a mock-up of taking a trade. Okay, look how big and clunky that arrow is. You see that? See that right there? If I pause that and I lay my mouse over top of it, does it give you the little tab that shows you the actual price that overlays the candlestick itself? It doesn't do that. See how big and weird looking that looks? See that right there? None of my executions have arrows that look like that. None of them. They have never looked like that. It has never happened, ever. Okay? So continuing on. Okay? And again, everything here looks stilted, wooden. It looks artificial. My executions are always done with live execution, with live data. Okay, it's very important. It matters not if it's demo or paper trading, because if I don't know what I'm teaching, if I don't know what the market's going to do, it's not going to work in that demo account either. Okay, because it's real-time data. It's real important that you know that. Okay, so I'll let this finish out. Watch this up here. Okay, it's going to change all by itself when the market replay finishes it. It's panning out. Let me catch a quick sip of my water while it's doing this. And there you go. Now, see what happens there? Does that ever pop up on my screen when I have a winning trade? No. It looks cool. It's neat, I guess. But, none of my examples are done like that. Okay? That never happens. It never happens. Okay? So, for the difference or contrast, if you look at now the executions that are done with live data, okay? Look how small and tight every single one of these little candles, well, not candlesticks, but these little arrows are, okay? See that? Even if I zoom in, watch. Do they become big and bulky and clunky looking? Nope. Those arrows are always a live execution, okay? That's the way it looks, okay? I'm glad that they kept that distinction between a market replay execution, because if you really wanted to fake and you wanted to be a fraud, you would be taking screenshots of these little arrows if they matched on market replay, and you would crop out all this up here. But I don't ever let that happen. I'm always showing you everything so that way you can see and cancel out anything that would have been done. Notice how these boxes are all back up here again? Because we're looking at what? Real-time data. You can't market replay the buy and sell buttons up here. They force you to use them down here. See them? See that? So now you know, okay? Now that you know that, you can shut the fuck up in my comment section, okay? Because it's stupid. Now, let's go over here and talk about what we're here for today. All right, market replay is turned off, and we have this business, okay? All right, so right away, some of you are probably thinking, well, I'm watching Top Step, and I was listening to Top Step while I was in the dentist office and driving back home too. I like listening to those guys because they were actually on the floor, and whether I subscribe to their views or not and how they trade, is irrelevant. Obviously, with all due respect, I don't. But I like listening to them. I like listening to their stories. I like listening to their banter with each other. So it feels good as a background sound. So I've been using them a lot as something to listen to while I'm either needing to hear something because I'm in a place where I need to be zoning out, like a dentist office is never pleasant to be in. I didn't need to go there for my son, but I like looking at the chat window too, because the chat window, much like I've mentioned before, it's a great sentiment indicator. It's wonderful. When I see folks getting real emotional or concerned or fearful about something in the market, that to me, if I couple that with something I see in my own price action study, what I'm actually doing there is I'm getting a measurement of my experience versus someone that I know is predominantly inexperienced or a novice. Okay. And there's nothing wrong with that. I'm not trying to, look down my nose at them and say, you're a pissant, you don't know anything, and you'll never become anything. It just means that if that resource is made available to us, I'm not going to turn my head away from it and say I'm going to ignore that. I'm going to go there right where I can see the real sentiment of someone that doesn't really know how to trade. And if they're openly sharing, and I'm glad that they're sharing it. And I would never ridicule any one individual or any one particular channel, but I get asked a lot, what channels do I listen to? Or what channels or YouTubers that I watch? And I love the fact that they have their chat window open because it is the perfect market sentiment. There was back in the 80s and whatnot, maybe even before that, there was a service called Market Vein where they would call up 100 different traders or brokerage firms and say, hey, look, you bullish or bearish on this market. And based on that sentiment or that cumulative total of how much bullishness or bearishness they would have on that market, they would share that percentage. And if it got real high, like 75 to 90% or higher on bullishness, usually you're near some kind of important high. And vice versa, if it was a market they were exceedingly bearish on, like lower 25 or 30%, then obviously you're probably near some important low. Well, I use that because day trading is a real popular thing today. And if I'm watching price action live and I'm looking for a setup and I'm usually watching a 1 minute chart, maybe sometimes under a 1 minute chart, like 15 second, 5 second, 30-second chart, I'll use those time frames. If I miss the ideal entry, I'll drop down below a 1 minute chart. Okay. Or if I'm really trying to smash somebody's opinion about me, I'll go down to a second chart and run it up real fast. Well, today, one of my sons, when I took to the dentist office, he was asking, how do I get in when the market's going sideways? And how do you know which side of the marketplace it's going to run to? Like, in other words, if you have a consolidation, which is what we're seeing right here, okay, all of this right here is a consolidation. And the question my son was asking is, when it's going sideways like this, how do you know which side it's going to run for? Because you can make an argument basically that there's buy side above this high or relative equal highs, or here's sell side below these relative equal lows or singular low. How do you know which one to work with? And that's why I teach folks to not try to trade during consolidations. You want to see the market show a displacement. Okay, but because it's my son, I don't usually try to teach these types of teachings because I keep it for my kids. But in the spirit of giving, the snow this morning really supercharged my Christmas spirit, if you will. And no, I don't decorate outside. I think it's too gaudy looking. I think it's beautiful on other people's homes, but I don't want it on mine. Okay, so I'm not a Grinch to it or a Scrooge to the idea of it. I'm not climbing out there on my house, and I'm not hiring a service to go out there and hang stuff on my house. I'm not having it. So that's why I don't have decorations or stuff out there. But the question again is, when it's in consolidation, how do you know which one it's going to run for? Well, that goes back to the higher time frame premise. When we're looking, let me get all this business off here for a second. We'll come back to all that. And we'll take this off. And if we're looking at how the market was ranging, okay, from Monday this morning, around prior to 7 o'clock in the morning, all through here, okay, if we're watching price like this, it's advantageous for us, for traders, because we need movement. Okay, first and foremost, we have to have movement. That movement is going to be instigated around time of day. Okay, so time is a very crucial part to my analysis concept, and it's what drives the algorithm. Okay, it's not price. It is not price. It's time. There is a time for everything that occurs in price action. There's macros, these small little short scripts where the price engines will create these little punchy short-term little fluctuations that you may be surprised by when it happens, but I'm not. My students are not. We're looking for them. There's specific times of the day, specific segments of the morning session, the lunch hour, when the lunch hour ends, the PM session, and right before the close of the day. Okay, so there's specific times where the algorithm will literally do this to create fear, greed many times is the factor that's, the engineered chemical response as a human. We're watching this and watching these candlesticks or whatever you're watching on your charts. They cause you to feel like you're going to miss a move. Oh, I missed that better entry right there that you were looking at thinking, I'd like to buy that. I think it's going to go up for now, but you don't really execute on it. You've been there 1,000 times. Trust me, I know. I did the same stuff when I first started. But when you know what you're looking for, there's going to be some times where you still miss that move or that better entry. These little times of the day will really, I guess, exaggerate that desire to get into it because you think, oh no, especially on a day where maybe you've had drawdown or you didn't do any trades in the first part of the day, you're feeling like, oh, well, I need to do something. I'm missing out on something. Okay, so fear, greed, or FOMO, not wanting to miss out on any potential movement, even if the movement is so minute you normally wouldn't trade it, but you feel like you have to do it because, that's what traders do, right? Well, you shouldn't have that mindset, but there are certain times of the day where these little things occur and they're scheduled. They're literally scheduled, just like an economic calendar has a scheduled event every single month. There's certain events that come out. You know what time they usually come out. FOMC is what? Always 2 o'clock and 2:30 is the conference. You know what time that non-farm payroll Friday is going to release. It's 8:30 in the morning, New York local time. You know these times. They're not changing them. Okay, so because they don't change them, that means the algorithm isn't going to change either. Now, if they had an economic calendar, here's how you know when they're going to change the algorithms. For all the folks that are asking this in the comment section, aren't you afraid that you're teaching so many people and they're making lots of money now that they're going to change the algorithm? They're not going to change the fucking algorithm because the markets are going to book the way they've always booked. They're going to run for liquidity. They're going to fill in and reprice to inefficiencies, and they're going to respond by sentiment, either by engineered from a market maker stance or from the weakness of poor trading and stop placement for liquidity. And they're going to use these volatility injections that occur around the economic calendar based on that time that event is scheduled to release. When does crude oil numbers come out? 10:30. Does it ever change it? Oh, we're going to throw them a curveball today. We're going to start sending it out at 1:45. That's not happening, folks. Okay, they work off of a script, and that script is not going to change. Now, if they start changing times when all these things get released, and you don't know until the day of, and it's just always constantly moving and fluctuating, okay, then they're playing the shell game with you. But they're not doing that. So there's no reason for you to be fearful that they're going to change the algorithm. They're not going to change the algorithm, okay? They're making so much more money than all the students collectively that I have that are profitable and everybody else's people that's claiming they make money too. They're doing a larger degree of volume against larger entities in the marketplace. Huge conglomerates, they're cannibalizing brokerage firms, okay? I mean, they're taking advantage of big pools of liquidity and they're chewing at it in small pieces all day long. They're not trying to do what you think you're trying to do as a trader, which is try to get the entirety of a daily range, the lowest of the low and the highest of the high. That's not what they're trying to do. They're not trying to do that. They're looking for pieces of it, okay? Just going out there, and I mentioned this before as an analogy. There's a little, tiny little shark. It's called a cookie cutter shark. It's not out there trying to devour anything, but it runs up real quick, slams in the side of whatever it is it wants to take a bite of and bites it and runs away. It lives. It gets to eat. Okay. And that's what these participants in the marketplace are trying to do all day long. And because they're doing thousands of transactions and they're doing it in such a small in and out, in and out, in and out. Okay. That's not buying and selling pressure. That's just them utilizing what the fluctuation in price is going to become anyway. Okay, and I'm going to talk a little bit about order flow. I'm going to talk a little bit about what the algorithm's doing, what real volume is actually occurring in price action, and how we can see and forecast the right side of the marketplace before it actually happens. Okay, so if you didn't look at what I was showing you on my community post this morning before you started watching this video, you can listen to what I'm doing here and go over to the community post, and you'll see what I posted was in fact, where we were drawing to. We were trying to get up into that 16,208.5, okay, because there was buy side up there. I'm going to teach you again with the premise in mind that you don't need to be correct to be profitable. The question goes back to what my son asked me this morning. Dad, when we're looking at it like this, how do we know which side of the marketplace it's going to reach for? Because you can look at old lows and old highs and say, okay, there's buy side and there's sell side, but which one am I going to focus on? Which one should I look for? Where is the draw on liquidity really going to be? Well, you have to look outside of the consolidation in and of itself. We're not looking, whenever the market's ranging like this, I don't look at this and say, okay, here's the buy side. In other words, let me really type it out because this is exactly what you're going to be doing. And this is where you get confused. My wife is not here in case you're wondering why I'm getting away with this. We can't keep getting away with this. All right, so if we look at that needs to be a little bit bigger. There we go. And then we'll do, not that. There we are. And for the folks who want to know what I just did there, I learned that from a student. A lot of my students are real savvy with these things because I'm an old guy and they keep up with all this. But what I do is I highlight the thing I want to copy, and then I hold down the control tab and I drag it away from itself, and it'll copy it for you. All right, so there's buy and sell, both respectively. And it's important for you to know this while you're learning, okay? But while it's in this consolidation, I do not teach, okay? I do not teach, I do not advocate, I do not want you to try to do what I'm pointing out here. And before I go any further with this, I want to make sure I say something. You're looking at the NASDAQ December contract, and I did execute on the December contract. I will not be executing on the December contract tomorrow if I choose to do anything. Why? Because if you go over to barchart.com and you look up the, where are we at here? You can use S&P or NASDAQ, it doesn't matter. You pull it up. All right, and then, I'm not sure why, there we go. I'm trying not to have all this ad stuff pop out, that's why I was zoomed in. You're not making money off of me, Jack. You can tell I've been looking for colognes for my son's stocking stuffing. Not these colognes, though. But the cash, you ignore that one. And the top one is your nearby or front month. That's December right now. So you got Christmas SPOOs right now, and then you have March. That's the next delivery contract. So we're rolling over from December that will be expiring, and then you go into the next month. So when this stops trading, this will fall off the board, and then the March contract will become the front month, okay, or the nearby contract. So we have this volume is 1,016,000, and March is showing you what? The volume is now larger. So I was willing to trade before seeing that volume. I didn't know what that volume was going to be. Could have been a little, lazy today and not posted the numbers that we're seeing. The open interest right now still is higher in December, but we're already seeing a lot more interest in buying and selling for what? The March contract. So I'm not going to get stuck in a trade when there's this much volume, okay? So don't be afraid to trade like this when you ever consider doing it on your own. But whenever you see these signs like this, okay, well, there's a whole lot more going on in the front month, okay, then I'll discount the open interest. But as long as the open interest is higher than here, I'll look to trade that until I see the volume become larger in the number of contracts being traded as we see today. So December today is the last time I touch ES or NASDAQ. So that way you understand, when do I roll over? That's exactly how I determine when I'm going to roll over. I don't listen to people on YouTube saying they rolled over. I'm not asking someone on social media, hey, did you roll over? This is what I do. Okay, this is exactly what I do. And I do it every single time a contract month rollover occurs. And since it's only 4 contracts per year when we're trading index futures, it's March, June, September, in December. Okay, so it's real easy to use this criteria. It's not complicated, but now because I've done that, I can close this, and hopefully you guys can allow me, because yes, it still says it's paper trading, okay? So when I show you my executions, just remember, I'm teaching. So therefore, because I'm teaching, I'm not licensed to give you trade advice. I'm going to protect my ass and make sure that I'm reminding you that it's in a paper trading account. So none of you can come back and say, well, I took a trade. No, you fucking didn't. You're a liar. Because I'm never going to walk you through a live account trade. It will never, ever, ever, ever happen. It will never happen. I will never open myself up to that liability. It will never happen. But I will sit out here all day long in front of whoever you want to put myself in front of, and I will talk about the market live in this medium because I'm protected. I'm not acting as a financial advisor. So it's really, really clear as to why I do what I do. But you want to see real-time, real live account trading, you can look on this YouTube channel and you'll see it. Just look down here. When you see the example, say AMP Live. That's AMP Global. It's a futures brokerage firm, and they have very, very competitive margins. They're in my mind, I think they're a little too extreme. They allow people to do way too many contracts for the size of money. But hey, a lot of people want to do that, right? So again, I don't rep them. I'm not IB. I'm not introducing broker. I have no affiliation with them at all. They're not perfect, so I'm not repping them. And I'm not telling you to go. In fact, don't put your money with them, so that you can see that I am not trying to do anything with any brokerage firm. I get requests all the time from companies. I don't do that stuff. So now, because I've done this, okay, I want you to know that I'm going to maximize the screen because I like to look at it like this. Okay, so now we're all on the same page. Now, hopefully I can go through this and explain it where it matters with what I was looking at, what I was expecting, what I would have used for a silver bullet, all those things. We're going to talk about that right now. So again, the question was, my son was asking, while it's going like this, what do we look for? What's the draw on liquidity? Where do we look to see price going? Where's it likely to go to next? Well, we don't look at just the original consolidation here and think to ourselves, okay, well, all we're going to do is look at the high and the low, and that's all that matters. Because I'm never teaching trading in this consolidation to get to just this level. That's too small. It's too myopic, and you're not going to do well if you're just looking at it like that. So what are we supposed to be doing? Well, you got to come off that 1 minute chart and go at least up to a 15-minute time frame. So with a 15-minute time frame, you can see that we had relative equal highs here. So that was an obvious level to do what? Anticipate price wanting to clean up this area up in here. So just like we have here, actually I'm going to just take that off there because we've already accomplished the method there. There. And we had sell side there. Now, while it's moved up here and we've moved sideways, inside this pre-market opening before 9:30, we were in this small little range, which was part of this consolidation here. What is it more likely? What is it more likely to do if you had control, like a video game, okay, or a remote control? If you had control to steer price, okay, and you had the benefit of controlling price with the expectation of knocking out other traders so that way you could take their position over where they get out with a loss. Where they get out with a loss, your intentions are to take that trade over exactly where they get out with the maximum pain that they felt and incurred loss at. You, because you're in control of price, you take price to that level to take them out. Their orders would be executed because they're stop loss. Or for folks that would be trying to trade as a breakout using that same location to keep trading in that direction. Either way, it's still using that liquidity for a counterparty purpose. If you had the ability to do that, and this is the part where people say the markets are not driven by an algorithm. They're not controlled by an algorithm. It's buying and selling pressure. And I'm telling you that's straight up bullshit. That's bullshit. Okay? And I understand. It feels good to believe that because that's the majority's perspective on it. But folks, listen. These markets are highly efficiently delivered artificially. It's AI driven. Okay, when they moved away from open outcry and it became electronic trading, it used to be only the seasoned people would trade Globex before we had electronic trading. You could trade Globex, but when everything became electronic, where now everybody has 24-hour access, you still hold on to these dinosaur archaic perspectives that markets are driven by the buying and selling pressure. I'm gonna differentiate what that really should be seen as versus what everybody believes it is. Okay, you're gonna know more about order flow today than any joker out there that's talking about bullshit that shows up ladders and DOMs and all that other stuff. You don't need any of that stuff. You don't need any of that. Now, if you use it and you make money, understand that I'm not trying to debate you on that, because that's your religion. You believe it, and I would never be convinced that the things I believe in aren't working for me either. Okay, but you're here watching my live stream. I'm not watching yours. So I'm teaching the people that have asked these questions, and this is my response to them. Okay, and these are also the things that keep me consistently accurate. When I show examples and I'm pointing out things, I'm leaning on this logic as to why I'm doing it, not trying to do something new all the time or trusting in something that everybody else is looking at, which is depth of market, level 2 data, volume profile, trend lines, moving averages, supply and demand, all these things, Elliott wave, harmonic patterns. What is the market going to respect today? Out of all that stuff, what's it going to respect? Is it going to go with Elliott wave today? Is it going to go with harmonic animal patterns? Is it going to go with, GAN? When you really take a step back and you think about it like that, because they're never in agreement. So what is it that makes the decision for the market to say, I'm going to be team ICT concepts today. I'm going to be team Elliott wave. I'm going to be team horseshit, whatever the hell it is that you believe in. It's foolishness. So, but what can we do to remove any level of foolishness? Understand that these markets operate on the basis of liquidity. They seek yield, and they like to reprice to cause efficiency where there's inefficiency. When you take a step back and you look at it from that perspective, it makes things so much more simpler. You don't have to worry about anything except for, okay, where's the maximum pain? Because wherever the maximum pain is, that's the path of least resistance for price. What does that mean? Well, I'm going to show it to you. Prior to this morning's opening, okay, before we go into further, I've mentioned this morning, the 16,208.50 level. I posted it as a small little chart. I didn't have much time to do it before I had to walk out of the house. But I said note it, okay? I believe that this is where the market draws to. Whether it draws there today or it draws there tomorrow for CPI, it matters not to me. That's the draw on liquidity for me, okay? I'm going to show you how I arrived at that, but I want you to understand there's other things that go along with this, not just pointing out old highs and old lows. There's other factors that I lean on. And I'm going to give you the procedure and process that I use that gives me that this is what I'm looking for, this is why I'm looking for it, and this is what I would say, no, I'm not interested in that, and this is why I'm interested in something else. Okay, so I'm giving you a real procedure, something that I know that when you read my books, it probably won't be conveyed as good as I'm going to show you today. So I'm giving you this example because it'll be something I can refer to, and it'll be like an amplification of something that several chapters in those books will talk about it. But you don't need it because I already talked about it before, but I'm going to show you what I use today, so that way it gives you a real world example. And going forward, you just lean on that same logic. And it's not 100% because nothing ever is 100%. But it's going to serve you better than trying to figure out what system, what methodology you should try to go to. And if you're always system hopping, trying to jump from one thing to the next, you're not going to find consistency. The only thing you're being consistent is your inconsistency in sticking with something until you learn it well. So because we moved off that 1 minute chart, a bellwether time frame for me is 15 minutes. Okay, so if I'm looking for something that is liquidity based, where I'm looking for a draw on liquidity that's going to have an impact for the session. I'm not talking about an hour candle where I can trade inside a 1 hour candle and I can get a scalp and I can make what an average person can earn in a week with every single 1 hour candle. I don't need to do that. You shouldn't try to do that, but for the sake of understanding the highest degree of probability where the market's going to reach for, you have to come off that 1 minute, you got to come off that 5 minute, go to at least a 15-minute time frame. Why? Because the majority of short-term fluctuations that's going on in intraday algorithmic price delivery is on that time frame. Now I'm going to say it in simpler terms. The liquidity you're looking for as a general go-to that's going to serve you the best is a 15-minute time frame chart. That's the ones that are so clear and they're obvious. They don't hide them from you. They can never hide them from you because this is the first one they work off of. Period. Don't believe what I said. Go back and look at every fucking day in every market and you'll see exactly what I'm talking about. It's there every single day. Now, over time, you're going to get good at it. You're going to get better at knowing which side it's going to reach for. But I'm going to show you it's not hard. When we're in this little consolidation in here, which is all part of this larger consolidation that's to the left, you see all that? Where is the market jagged versus where it's smooth? Now, for the folks that don't know English very well, what do I mean by that? Well, if you look at the difference between how this high and this high and this high and these highs here, you can pretty much see how these are all like real uniform. It's real smooth. It doesn't make any kind of real jagged run up and run away. Notice that? But where do we see that type of delivery and price? Down here. This is all jagged, okay? So if you were looking at it like a sawtooth or the edge of a saw or some type of serrated edge, down here, they cut up all of the liquidity that was resting below that low, it ripped through it, it caused this one here, and then what did it do? It ran right up here, but then it left this nice smooth little area right in here. So what happens is that retail-minded traders, they see this price action, and they envision this little area right in here. This is their safety or safe house. That's this little area right here where they feel that if they go into the marketplace and they try to go short, they feel that this is it's a safe room. Okay? My house that has one. Most other people that have high security and things like that. Those places in your house where it's fortified, it has means of protecting yourself with food, water, medicine, weapons, lighting, communication where you can talk outside the house without even having a connection with your house phone. Who even has that anymore, right? But the idea is this is a safe space for retail traders because they trust this as what? They see this as what their textbooks have taught them all along, that this is resistance. They think that price cannot get through that. This is strong resistance. So that means what? The market has to bend to its will if they're classifying that as resistance? That's exactly what those books taught me. And I lost my fucking ass. Okay? I lost my ass trying to use that logic. Every single time I trusted what I thought was obvious and strong resistance, if it looks smooth like this, you can bet your ass they're running through that. Just like the SWAT team's going to kick that door in. They've already done the SWAT move down here. They've already busted through the door. It's all busted up and jagged. Here, it's all smooth. Real smooth highs. And they do this to instigate the idea that it's safe to trust that as resistance. So what will traders do? They'll want to go short. So when they go short, if they're thinking about protecting their money, and that's a good thing, they'll place their stop loss right above these highs. What kind of stops? Buy stops. Okay, so they're thinking that if they can go short in here, or they don't catch the move, they see this run here, what are they going to do? They're going to chase it. They're going to chase it and go short. Then they have all this potential inefficiency they could actually see go against them while they're in a trade, and that might squeeze them out. Or if they're just a chaser in price because they don't know where the market's going to go, and they haven't really over leveraged. They use the smallest in terms of leverage. They can afford to even chase it, even though that's not a good way of trading, but they can afford to put a stop loss up here because they're not trying to trade with 15 contracts. Wink, wink, nudge, nudge. They have the smallest leverage on, so they're going to place their stop loss up here because they understand they're not that great in terms of precision, but they know that this is proven to them that they think it's going to be acting as resistance. It's not, but that's what they're being trained to think. So if you do this over and over and over again, reading books, looking at the examples that they want you to see, you will believe, you will be indoctrinated, seeing that this is resistance. So therefore, the market should not go through that. See how that it ingrains in your mind that you're going to believe it because you paid for the book. You took the time to read the book. And these people are claiming they've been doing it before you and they claim it works. So right away, you're being brainwashed. I'm not trying to brainwash you. I'm telling you, don't believe anything I say. Use the logic that I'm talking about and go in and see if it doesn't work for you. In every single instance, the people that try to do that with a real interest in trying to debunk it, they become a student and then they get fucking funded. They make money, and some of them have gone on to make a lot of money. And that's how I market myself. I'd say, don't believe what I say. Go in, use the logic that I'm teaching you, and you see if I'm full of shit or not. And you'll right away know if this stuff works. You don't need to listen to somebody else. And when you see this logic that is turned on its head, retail logic is what I'm referring to, there's no need to go down below all this stuff or even revisit it. When this is left intact, this is all smooth. This is all smooth. And it needs to be made jagged. So if price is down here, how do we use that logic? To answer my son, I said, look where this is smooth. And you see how this is smashed down several times? It looks like, sharp teeth on the side of an edge of a saw, right? So they tore us all up down here. And this is all left smooth and intact. So when we're in these small little consolidations like this, and you don't know what side the marketplace is going to run for, look for where it's left smooth edges. That's this side here. I was not bearish this morning. You should not have been bearish if you were a student of mine because we've already seen how they've done the damage down here. Plus, the market is still trying to reach for that old daily high. What do I mean by that? Let's go up to a daily chart. See this one over here? On the weekly range, my analysis says I'm going to look to see if it can try to trade up to that. So until proven wrong, unless CPI comes out tomorrow and completely decimates all this market structure here, I'm anticipating today or going into CPI tomorrow that we run up into and through the 16,264. Now, obviously, I'm using the December contract. So let's take a quick little peek real quick over at the, this is the symbol for March 2024, okay? So when you're on TradingView, it's NQH. The symbol H is for March. The symbol for June is M. The symbol for for September is S. And the letter Z is for the December contract. So we're rolling away from the December of 2023 into March of 2024. That H is for that contract month. Okay, so if you do this, you can see my level's already there. So it's already close to that, and then this one right there. So let me drop it over here. Doesn't take much to get to the March objective. And we pierced it today. I don't think it stops there is what I'm getting at, because I'm using the logic that even though that its volume is rolling out of December into March, December's still going to be traded. December's still going to be traded even on the day of expiration. It may not be a lot, but it's still being traded. So I'm not advocating for you to trade it that long, but there's unfinished business up here based on what that front month right now, which is December still, even though volume is highest in the March 2024 contract, December's still active. So you can't discount that. So when I'm looking at it, I don't just simply say, okay, forget what December contract's doing in its chart, only focus on 2024. Because if you do that, you are literally putting blinders on. You can't, simply because you rolled over, and you're actively trading now March contract in 2024, if you're trading this contract here, and there's nothing wrong about doing that, but you can't ignore, you can't be oblivious to what that December contract still has in play, because that liquidity still is what? It's a factor. So if we have that in mind, we go back into December contract here. Go back down into the 15-minute time frame. So while we're in here, we're going up into what? Time. Okay, Dave, listen. Don't get too crazy, okay, because time is still the most important thing. You're taking a post I made on Twitter out of context. I was practicing just reading price action just by in and of itself, but the importance of time cannot be diminished. All of the real moves, the sustained price runs that run for significant price runs to inefficiencies or liquidity, are going to be based on a time delivery schedule. It is always based on time. Time. Without time, you can't do shit. Period. You can't do anything. Because if the market ain't open, can you put anything into a trade? No. That you might argue and say, well, that's the extreme argument. And of course, yeah, it goes without saying. But none of the sustained price runs or significant price runs ever manifest themselves out of the time periods that I pointed out. Look at the macro. That's a small window of time. 20 minutes, 20 little minutes, okay? And I can time every significant price run that's going to occur intraday on a 1 minute chart. That's what a macro does. So can you tell, can you hear how I've been wanting to do this and I've been starved? I didn't want to be here. I didn't set my schedule to be here for a long time, but I've been really missing doing this. And now because I'm out of the cage for a little while today, I'm having fun with it. But don't discount time or place price over top of time. Time is always going to be paramount and above price. Always. Every instance of it. Every single instance. Time is going to be the absolute paramount principle that is going to be the largest factor in why price is going to move. Don't believe me? Look at the economic calendar to cancel any argument against it initially right away. Because CPI tomorrow, when that comes out, it doesn't matter what the fuck you trade. It's going to rip your face off. It's going to rip your face off. You're not going to be able to trade it. You're going to be decimated. And nobody can stand in front of that. Not with any assurity that they're going to be, having an outcome that's favorable. Not consistently. And I feel like I'm a pretty good trader, and I can't find consistency ahead of CPI every single time it comes around. Once in a while, I'll get it right. Once in a while, but most of the time I'm not. So I have to wait for that first initial delivery and then look for where it left porous wake in that price run. That means inefficiencies, fair value gaps, and what liquidity in terms of old highs or old lows that they left smooth like this. Is that complicated, folks? Forget everything else that this jawbone about, okay? Isn't it easier for you to not worry about what setting your indicator should be on, or what indicator to even use, what moving average, what fucking trend line to draw from, okay? What volume node to worry about. Nothing about a depth of market. You don't need to worry about what any particular price at on any DOM is going to be any factor for you. No, it's not needed, because you can clearly see at this level here, 16,120 has buy side or buy stops resting above it because it's smooth. You don't need a depth of market. You don't need level 2 data. You don't need a market map or book map or anything else out there to do this. It's all on one chart, one time frame. It's the 15-minute time frame. Okay. The same thing we see. What is this over here? Aren't they smooth? These are smooth. These are smooth. It's all part of that same consolidation, isn't it? What do we have right there? It stepped outside of it. Did it stay there? No. Did it retreat away from it? Yes. But we're going into the time. What time? 8:30. But there's no news coming out at 8:30, Michael. It doesn't fucking matter, because 8:30 is when the algorithm's going to do it. It doesn't matter if there's no news there. Doesn't matter if your economic calendar says there's a medium impact news driver or a low impact news driver or a high impact news driver. It's going to start running based on that time of day. Now, that means, okay, listen, friends and neighbors, listen. If we can look at price like this, we can already come to the conclusion that we want to anticipate and expect and not be fucking surprised when the market goes up at 9:30 and into the lunch hour. Why? Because it has all of this and this on the daily chart to reach for. Remember, that December contract is active right now, but it's rolling over. Do they want to leave those individuals that have a stop loss up here in before the rollover is completed and now March is still now becomes the front month and most active? They're not going to do that. It's most likely not. Let me rephrase that, because I've done this one time before and it didn't pan out. But I want you to hear the logic. This is what I lean on, and as to why I'm doing it. Now, take away the rollover aspect. Say that is not a factor right now, and you're trading at a time where it's weeks or months before the contract is rolling over. In other words, we have plenty of time before the contract you're trading expires. Okay, take that out. Everything else remains the same. Is that complicated? Am I hiding something from it, from you as the student? No, I'm literally simplifying this. The only thing you're doing every single day is determine on the weekend, you're going to look at that weekly chart and say, okay, well, let's do it. It's a lot easier just to simply do it, right? Let me take these off. We'll go to a weekly chart. All right, here's that high. You see that? This is the December contract. It's the front month. It's still active. This is where buy side is residing. We went down into a fair value gap between here. So it dropped down halfway point. Look at the midpoint of that rectangle. And I got a question in the comment section. I'm glad I just did this. One of my students asked, how do I get that little horizontal line in the rectangle? When you go to the rectangle properties, go to style, middle line. If you toggle that, it'll put the that line in there. See how it goes right down to the middle? Perfect. That's algorithmic. That's not harmonic. Fucking harmonic. So buy side liquidity here. That's my understanding, and my expectation is they're going to run for that level. Not because that is an old high and its resistance, but because there's orders up there. There's an interest to get out of the market that are long. And large funds absolutely have liquidity in the form of a buy stop right there. Because they're trying to do what? They're trying to ride down long sustained price runs. And they're not trailing their stop loss here. No, they don't trade like that. There's many models that run on a large fund level that they never move their stop because they have a long-term trend following model. They don't want to be babysitting it. They don't need to, because even if they do get stopped out over time, I'll give you a perfect example, the turtles. Their accuracy sucked. It was atrocious, but they had sustained price runs that they could be participants of, and that's what carried them through. So they had very, very low strike rate. That means the accuracy of their trades were very low. But their winners, when they were winners, were huge. They would catch, think about it like this. If they went short here or you went short here and you rode it all the way down here, forget what I'm talking about here in terms of not trailing stop loss. But if that was a sustained run over the course of months, not weeks, even though it is months, but say each one of these was represented by a month. That gives them the opportunity, should they trade to a target or objective that's met, they could be taking down huge harvests of profits, millions of dollars. And they can afford to take losses of $10,000, $20,000, $30,000 losses in the grand scheme of things, because if they're taking millions of dollars out when they win, are you going to lose sleep over that? Even if your accuracy is less than 20%? Think about it. So anyway, the point is my analysis this weekend, while I was sitting outside looking and hoping that we get a white Christmas, the chart was telling me I want to focus on this high as a draw on liquidity for the weekly chart. So right away, does ICT want to go short this week? Hell no, I don't want to go short. I don't want to be short. I don't want to look for anything short. But I have to be aware of what? That high right there that failed to get there the first time it tried. So this high here is important. So these two levels you would have on your chart. These are very significant price levels that you have to have awareness of. I have a notepad. It's a simple little tiny little yellow notepad. I've shown it to you before. I'm not going into the business of showing you what I'm writing, because every single time I mention this notepad, you think I have something secret written down on it. And the only thing I have written down are specific levels that I'm highlighting, just like I'm showing you here. Instead of having it on my chart, I'm writing down the levels that are shown. See the blue lines? See the levels they are? What level is that? 16,208.50. Where did I get that level from that I posted on the community tab? There. It's important to me. This, should we trade above it? This is where I think that we're going to go for the week. See that? So there is a draw on liquidity that I'm looking for that may be a factor. Doesn't mean I have to have it go there. It doesn't have to go to these levels if it's used for the context of a intraday objective or a session, like if I'm trading the morning session in the indices, or if I'm trading the afternoon session in the indices. I have an objective I'm reaching for. But when I execute, my trades do not have a dependency on that target being met before I'm profitable. I'm going to say that again because for some of you that are new, it went right over your head. There is a best case scenario objective or target that I believe that the market will want to reach for. I do not need it to get to that level before I profit. I'm looking to engage price with that in mind as a draw for price. It's like a magnet. It'll pull price towards that level. And it matters not to me as the trader if it trades to it. Now, what does that do? It removes all of the fear about being wrong and the importance of being right. It's completely canceled out. I'm trading with probability. It might go there. There's a large degree of probability that that pool of liquidity above a high or relative equal highs or something to that effect, if I'm bullish, it might reach there. It might reach this high today. It might. But guess what? My example I showed this morning, well, I'm going to walk you through, didn't require that and still was profitable. Demo, because I'm teaching it. When I'm not teaching and I'm quiet and I'm showing examples and I'm showing other people out there that claim they make money and that I don't trade with real money, I'm doing it with an AMP account. I went into, I can't remember the name of the company now. Give me a second here. I got to go on my phone. I'm having a senior moment. Thinkorswim. Okay, Thinkorswim. I logged in. I showed 3 months of trading. Okay, everybody that's out there crowing about how I don't ever show a live account and I've never showed statements or never show a loss, go in there and ask your guru to go in and show the last 3 months of their trading. They're going to fucking clam up and shut up and probably block and ban you. Okay, every question everyone's ever asked of me, I've done it. And now I'm going in the Robbins Cup, and I'm going to fucking win Robbins Cup in 2024. So shut your fucking mouth. Come in there and compete against me if you got something to say, because this is your last time to do it. This is your last time to do it. But there has to be a rule-based idea on what you're trying to do every single day. And if you don't stick to that rule-based idea, you're going to wing it all the time. And when you get lucky, you're going to attribute that as skill falsely. And then you're going to go into the market on another impulse, thinking you're doing something that is skill, but you're not doing anything that has been consistently followed. There's no rule-based idea. There's no protocol being used. You're just winging it. You get a hunch. You followed somebody else on social media. Oh, they're doing this, so I think it's going to go there too. That's why I don't want to teach you that way, because what that does is it creates a codependence. I want you to have independence in your ability to read price and find your own setups and trust what you're doing is going to lead you to an expectation and result that you're going to be satisfied with, and not have a leash or a tethering to me or anyone else, because that sucks. That doesn't give you confidence, because what happens if I was doing it all the time, if I was giving you my trades and let you follow me, if I said, okay, I'm done, you want to crucify me and burn me at a stake, because now your income is then cut off. Replace me with anyone else that you're trying to follow for signals, because that's exactly what you do. You're placing yourself in a position where you're dependent on them constantly feeding you, just like your employer. Fuck them. You want to be independent. You want to get away from them. You want to get away from them and have your own mindset, your own ability to follow the rules that you've grown accustomed to trusting. They served you well in the past, so therefore you're going to trust them just like you trust the route you take to work every single day. You have a favored route you drive to work every single day. You might have a detour. There might be something going on that you get jerked out of your comfort level, and you got to take another route to get there, but you can still find your way to work, right? Well, that's why I have more than one model. I have a model that I love. I have a model that most every single day will appear in some capacity or another. And if I don't get that one, it doesn't mean I can't take a trade. It just means, oh, okay, I can't use that one. Or if I get in front of the charts and I miss a move, okay? For instance, I was at the dentist's office with my son. And well, hopefully I've already communicated this. Okay, so this is a daily objective because we're real close to it. And then for the week, I think that we're reaching up to here. It doesn't need to go to either one of these for me to be profitable. That's what I'm getting at. Okay, so now we can go back down to a 15-minute time frame. I'll go back through all of this, and it should take me back into the 15-minute time. Here we are, the 15-minute time frame rather. I wasn't in front of the charts, and I wasn't going to try to execute anything from my phone because I was getting questioned by the dentist. Do I want to do this for my son, or do I want to have this procedure done? Do I want to have his teeth sealed? All kinds of other stuff. So I knew if I entered something and they were going to ask me questions, it would distract me, and I can't do that and trade. I got to have my peace of mind and not have anybody messing with me. So had I been in front of the charts, okay, using all this logic, we're in here expecting what? 8:30 is going to start the clock. It's going to start running. So you have that 1 hour window prior to what? The opening bell at what? 9:30 New York local time. So right here on this candle, that's the 9:30 candle. Don't worry about time, you say? Well, there's your volatility coming in. What's it running for on that one single candle on a 15-minute time frame? What's it running right for? Where retail thinks they're safe. They're safe right here, they think. No. Despite what your bedtime story tells you, there are monsters under the bed. There's monsters in the closet. And they're going to come out and snatch your ass up, despite whether you believe in them or not. Because that's what this market does. It cannibalizes. Whether you want to accept it or not, you like to walk in here and think it's a sporting event. You want to have analogies that make it seem like you're running a race. You're climbing a mountain. It's all great. It's an independent sport. You know, it's wonderful. It's not. It's fucking war. Okay? If you're on the other side of my trade, I want you to be dashed on rocks because I want your money. And you're going to take that sound clip and place it in things that are out of context. But that's the mindset I have. Anybody that's on the other side of my trade, I want them to be wrong. Why? Because for me to be profitable, I have to have someone take the other side of that trade that is an opposing view. Now, for people that take this and they think, well, that causes a moral dilemma for me because, you know, my belief, my faith, my religion, my whatever says that I shouldn't do that to people. Well, here's how I get around this, okay? The parable of the talents, and I'm not going to be preaching, but I just want to answer this because it's been brought up many times. If you read it, the person that just buried the talent and didn't do anything, they were chastised and said, listen, you should have at least put it into the bank or the equivalent so that way they could get usury or interest on it. But they didn't do that. So that means you're investing. So when you invest in a 401k, does that 401k have a guaranteed outcome and profitability? Fuck no. Nobody has that. But what are you doing? You're investing. You're placing an investment in it. What does a farmer do when he's out there planting all of his crops and stuff? He's doing what? He's making an investment. Does he know he's going to have a bumper crop? No. So is that gambling that he's planting and trying to put forth an effort to multiply what he's been given? No, of course not. He's not gambling. He's investing. So when you listen to these people in the pulpits try to preach and teach to give you them 10% of your money, but trading is sin, they're a liar. They are a liar and they are a wolf in sheep's clothing. Okay. I have no problem with trading. I have no problem with investing, but I have to understand and respect the food chain here. Okay. When you first start to do this, you're going to be a losing trader most of the time. Now, the way I sleep at night is I look at it when I win and someone else has lost the other side of that trade. I tell myself they're a novice. They'll either learn from it or they'll be smart and stop doing it altogether. That's how I work it out with my own mind. That may not work for you, but that's my answer for it. Okay. I don't feel bad for the people that lost money because they signed the same risk disclosure that I did when I opened up my live accounts. But you don't ever read them. You go in thinking you're going to be right all the time. And that's not practical. That's not realistic. Okay. That's why I never sugarcoat anything. And for people that come here and they hear it taught to them like this, it's like, well, I want to go to somebody else who's going to tickle my ears and put a feather on my ass and make me feel like I'm going to win all the time. Well, that doesn't work like this. The real world's going to be very harsh. It's going to take something from you every single day, whether it be confidence, money, hope. It's going to instill fear. This is war. This is exactly what goes on all the time. But books aren't written like that because they want you to do what? Feel good about the author. I don't give a shit if you like me. I'm telling you what this market's going to do, why it's going to do it, and why it will do it consistently in the future without me talking about it anymore. That's what you should want to have as an educator. You want someone that's going to tell you, cut through the bullshit, please. Tell me what I got to focus on, and how am I going to make a mistake, and how can I rectify that or prevent myself from repeating that same over and over effect where most traders that are retail never acknowledge that they're wrong. They never acknowledge that they are the problem. It's always the system. It's the person they followed, their logic. It's flawed. No, it's you being stupid and impatient. Just like I was when I first started. I was foolish in thinking I was going to be able to do it right away. I went in there, started trading with real money in 1 month of reading a raggedy ass book that had no basis of knowing what the market was going to do. But I believed the bullshit. I believed the bullshit. And I went in there, and the first trade, I lost 50% of what I put up. And that scared the hell out of me. So it forced me to go back and say, okay, I got to know what's going on. And one of the biggest epiphanies I had was the markets run on a time-based delivery schedule. That means you could set your clocks to when these market moves are going to manifest themselves. And if you limit to your trades to these specific times of the day, and if you get a win and you get out of that trade, whether it's premature or not, you stop. You stop. Okay? One of the questions that come up a lot is how do I hold on to a trade? Like, how do I hold on to a running trade? Well, admittedly, there was no way I was going to be able to feel comfortable managing what I put on this morning, as I'll outline and show you to you. But I had travel time to get to the dentist. I knew I was going to be asked a lot of questions, and I didn't want to have the phone in front of me managing a demo trade of all things in front of the dentist that's going to be asking me questions about my son, which is going to be rude. So I set it up where I knew it was going to likely run to the objectives. I'm going to walk you through what those limit orders were posted at, why I chose them. I'm going to explain everything. But it's real important that these parts of the conversation that you don't want to listen to, this is the mindset part. This is why I know when everybody else talks shit about what I teach and what I do and what I know, and I can do next week, next year, even 25 years if the Lord gives me that much time, this stuff's going to work the same way. How am I confident about that? Because I know what I know. You don't even know what you don't know. So how are you going to argue that? See, you're standing on a position that is of ignorance. You have ignorance. You have no experience. And you're trying to convince yourself, don't bother trying to learn this because you're probably going to fail. And until you overcome that, you're not going to be a trader. Not one worth anything in terms of profitability. You're going to fail because you've talked yourself out of it. And a trader that's going to be profitable, they already see the end result. Like, I know when I'm looking at a market, I know what I think the market should do, and I have to submit to what? Time. I got to give it time. But I also have to be in front of that chart at the time when that market move is going to begin, because they're all time-based delivery. We're in this consolidation. We walk through the idea that this is too smooth, so it's going to run for that buy side liquidity. So if it's going to go above here, how far can it go past that ICT? Well, that's where this level came from. Remember we were looking at the weekly chart? That's what this level is up here. So 16,000, I'm sorry, that's the daily chart. There's another level up past that. Getting a little overzealous, Michael. There you go. 16,264. That's the weekly objective. So in my mind, when I was looking at it over the weekend, I felt that we could try to challenge that high here, maybe before the contract expires for December. But it doesn't have to do that. I got to take you back to this, okay? It does not need to trade to this level here for me to be profitable. It never needs to go to that level up here for me to be profitable. So when you're taking trades and when you're trying to engage the marketplace and you're putting on an entry, hopefully using a stop loss, and you're putting a target in, are you using the hardest target to reach for as your objective to get out at, or are you using a low-hanging fruit objective? Based on your analysis skill set that you have right now at the time of listening to me, whether you use my logic or if you use somebody else's horseshit, whatever it is that you're doing as a trader, whatever that is, are you demanding the highest degree of profitability for that trade to yield you your only profit? Because if that's what you're doing it wrong. You're absolutely doing it wrong. Because what you're saying is, in your ignorance, in your infancy as a trader, you don't have very much experience, you're trying to make this harder than it has to be to learn. You're demanding an Olympic level result, a gold medal result, while you're a novice, while you're a neophyte. I mean, you don't really know anything about yourself as a trader, let alone what the market's going to do. So you have to give yourself room to grow and bloom where you're planted. So that means, yeah, you might see this same objective here. You might have looked at this level here. Wonderful. But in the beginning, you don't have the wherewithal to hold on to it. So how do you get to that? You have to grow into it through growing pains, taking off the trade before as it reaches into it, and then watching and seeing what it does afterwards. Oh, it did go there. Okay, what does that do? Number one, it removes the pain of being wrong if you are. You've paid yourself with a partial. You participated in a move that you did analysis on, and you've removed any possibility for you to feel the sting of being the wrong side of it. But you can still appreciate you being wrong if it never reaches there. But you did what? You made money, or you have a positive result. You see the difference between there? There's a huge paradigm shift in that retail traders don't tap into, because most of these retail teachers and educators are full of shit. They don't make any money. They don't know how to trade. And that's why they write books. That's why they sell courses, and they still sell courses, and they still sell courses, and they still sell courses, because that's where their income comes from. Think. If the shit that they do is so good, wouldn't they be doing it? Wouldn't they be out here showing you it consistently? Wouldn't they have students that are popping up all the time doing the same stuff? Yes, they would. But most of the authors I bought books from have none of those things. They don't even have examples where they've done it. They just talk about it in hindsight, pointing to something that here. And there's a stage in your learning that's important. When I teach and I tell my students to backtest, that's exactly what you're doing. You're looking at hindsight moves, looking at the framework of what the market has done. What did it utilize? Did it use a fair value gap? Did it use an order block? Did it run liquidity before it ran there? Did it reach for a single high or a relative equal high? Did it reach for a single low or relatively equal lows? When you're looking for liquidity, there's only two things you're looking for, folks. There's only two things: a single or a double point of resistance or support, because that's what you're attacking. You're not trading support and resistance. You're fucking running through it like the SWAT at the door of the drug dealers, okay? You smash through the doors of resistance. You're smashing through the doors of support. I do not trade support and resistance. I attack it. I look at it from the lens that retail traders trust these levels. And because they're stupid and they don't know anything, just like I didn't know shit when I first started, and I'm not trying to be condescending to someone that are new. I had no business getting in there with real money trading 1 month after reading a raggedy-ass book. That's who's talking to you. The guy that can do all this stuff and tell you before it happens and do executions, it's great. I started prematurely, stupidly, because I wanted to make money fast. And that's exactly what most of you are listening to me for and other people. You want to learn how to make money fast. And I'm telling you, you need to learn how to make money slowly. Because you don't know who you are as a trader. You don't know what you're going to do to hurt yourself. There's a gray area that no mentor can fill in, because you have to discover who you are as a derailment. How are you going to derail yourself in your progress? Because that's exactly what's going to happen. There's never been a trader ever, not one fucking person, and they come in and say they didn't. They're full of shit. Everybody goes out here and does their own ass in. It will happen to every one of you. But how are you going to think about yourself when you do? Will you want to fold up and say, that's it, I'm done, never going to trade? See, that wasn't in me. I failed a lot. Many, many, many times. Okay? Many times I failed. I blew lots of accounts. But every single time I blew those accounts, I could go back and look and see what I did wrong. And the encouragement I had from that was, okay, I remember being in that trade, even feeling like I needed to close it and reverse it. But I didn't. Why? Because I didn't have the experience. But guess now what? I can look at that and say, I should have done that. So now I know when I get to that same instance where I see something in price action, I've been there before, I know what it's trying to reach for, I will have no problem getting out of the losing position I'm holding, reversing it with half the position I was holding in the other side of the trade, and then I will make the loss back many times and then make new profit. But I didn't have that ability to see that when I first started. That was something alien to me. I didn't think that was something anybody would even want to do, let alone teach in books, because they don't teach that. They give you one-trick pony mindset, support, resistance. Look at these ratios in Fibonacci. This is harmonic. Bullshit. Bullshit. Okay? Bullshit. Because if it was as simple as that, just as simple as support, resistance, everybody would be making money. For some of you that are sitting here talking, well, look at what it's done. It did support resistance here. This level here, this low, did not even touch this high here. So how's that support resistance? I've done many times when I first started as a 20-year-old, I was in here thinking, okay, here's support because it's resistance broken here. I'm going to put my order right down there. I'm going to try to buy it. And it did this. And I'm punching the air because it ran off without me. How many times have you done that? Honestly. There's no way for me to know how many of you are actually responding to this. But you know damn well. You've been there. How many trend lines have you drawn? Diagonal, support, resistance. And it never reacted off your shit. But the times that you did try to trade that diagonal support, it ripped your ass apart and went right through it. So I learned from that and said, okay, I'm looking for phantom trend lines. I'm looking for those instances where retail traders are going to see that stuff and have faith based around it. And they're going to put their money in there. So if they're going to put their money in there, I know I have a loser on the other side of my trade I'm going to take advantage of. And I'll let you wrestle with the moral dilemma about that. I have none. I have zero qualms about that. None whatsoever. Zero. Because I lose just like they have lost on that trade. Difference is, I'm coming back with interest, motherfucker. I'm not going to stop trading when they pack up their shit and say, I'm not going to do this anymore. I'm not going to try to do another combine. I'm not going to get a funded account. I'm not going to put more money in my live account. I'm not going to trade anymore. That ain't me. I'm not built that way. I'm not built that way. And I try to instill that in my students, whether you like the language I use or not, it's irrelevant. Because I'm not going to sugarcoat it. I'm going to tell you exactly how you should learn it, what you should be thinking about, what the impediments are going to be in front of you many times, because you're not the only person that's going through the same thing that I went through and everybody else goes through. You're afraid that you're going to fail. You're afraid it's going to take you longer than, there you go. We just ran through the high. He never calls it live. He never tells you in advance. Joker boy, in my comment section, go fuck yourself. Because I do this every single week, even on vacations. Okay. So the point is this. The price action is delivered on a time-based schedule. Okay. I give you very specific key times. It's in the core content. It was taught a lot in the Twitter spaces. That I'm not on Twitter anymore, but there's a lot of folks that have put them on their YouTube channel. I got no problem with that. I do have a problem, and I've been yanking down other people's channel and uploads of my core content lessons. I'm pulling them down. And when you ask me to take the copyright strike back, I'm telling you, go fuck yourself, because you don't have the right to put my content up there. But Twitter spaces and stuff like that, you're welcome to do that, because I don't want them on my channel. But in those presentations, for the people that were really there to listen and learn, I was dropping down serious gems. Things that I didn't really focus on teaching in my mentorship. I was laying it down for the first time. Macros. Oh, you said you were going to teach. I already taught macros. I've already taught them, but you don't want to listen. You don't want to go looking for it and going through the process of taking the notes. Okay, you want somebody to come around and tell you a 5-minute trainer. They may tell you ICT said 10:50 to 11:10. That's a macro. Okay, what are you going to fucking do with it? I just gave you a 10-second concise presentation of it. What are you going to do with it? You still have to know what I'm showing you here. What's it reaching for? What is it reaching for? What is the market reaching for? And if I'm in live streams listening to other people who I have a great deal of respect for because they're willing to go out there and put their opinions out there, or they're telling you that they're taking the trade, and you may not actually see them, but they're saying, hey, I'm long here. The guys over on Top Step, they'll tell you, yeah, I just took a long, and right away, like Michael Pataki, yeah, I just took a trade here, and there he goes. He gets stopped out. He's got no problem. He's telling you he got stopped out. It's a loss. What's he doing right after that? Rolling right into the next one if it's there. He's trading. Okay? He's trading. His mind is seeking yield. He's looking for the next setup. Okay? It matters not what means of engagement that he uses. It doesn't matter, what it is that you're using as a PD array if you're using my content. Whatever one you've grown an association to and affinity for, that's the one you're going to trade. It doesn't matter what other students are making, how much money, or if they're on a leaderboard of this payout funded company, or if they're showing you their withdrawals are this much or that much. That doesn't mean shit to you. You can't spend their fucking money. They're not going to give you any of that money. So why are you counting pocket change on other men results? That's dumb. If you want to be inspired by that, great. That only happens in the first month or two. Because once you get inspired to do it, stop looking and counting other people's pocket money. If you're going to pocket watch, you're never going to pay attention to what these candlesticks are doing. You're never going to learn how to trade. You will never do that if you're constantly pocket watching other people. What are they doing with their money? Who gives a fuck? Who gives a shit what they're doing with their money? Who cares? Because you're not going to spend any time driving their car. You're not going to spend a night and make sandwiches in their fucking kitchen of their nice house that they're renting. And you're never going to be able to wear the watch that they're saying they probably paid too little for because it's a fake and fraud. And Rolex is a piece of shit. Get a Patek or you got nothing. The point is this. Your focus should be primarily on you, what you're learning today, and does it work? That's the first stage, okay? And it's free to learn that. It only takes about a month to figure out that right away. And if you do everything I suggest, that you go in and you look for these signatures and price action, you'll be convinced that there's something to keep researching in this YouTube channel. And then you will see a lot of different things that won't really resonate with you. And that's a normal thing. It's normal. If you don't like breakers, or if you don't like mitigation blocks, or if you don't like the optimal trade entry, it just doesn't resonate with you, and all of a sudden now you like the silver bullet, well, guess what? Don't look at anything else. Period. Don't watch any other fucking video on my YouTube channel that talks about another PD array. Because the only thing you're going to do is second guess the affinity you have now developed towards the silver bullet. And I'm not saying the silver bullet is the best. I'm just saying it's the easiest visual representation of how I can teach someone to get in the marketplace. And we're going to talk about it in a minute. But these are all the important factors that you have to have in your mind while you're trying to learn how to trade, whether it be my stuff or someone else's. Because this is what makes the market move. The perceptions of what one set of traders that are myopic or neophytes, they have no idea what they're doing. They have no idea what the market's likely to do. They've never been here before, or they just started, and they've never had a winning trade, and they're sharing their opinion in live streams. Oh, I'm bullish here. Oh, I think it's getting ready to crash. Oh, it looks heavy. Oh, it looks toppy. Or it looks like it's getting ready to rip. I fucking love seeing that shit in chat windows. I love it. Because if I'm looking at a marketplace and some guy or gal in the chat window and another live streamer's shit is talking like that, and then you see what? Yeah, I think so too. I'm on the same page as you. Or yeah, I think the same thing. I'm doing what you're doing. That's herd mentality. I'm a fucking wolf. I am an apex predator. I want you to show me that you have a bad leg because I'm going to run your ass down and eat your ass. And that's what these live streamers provide for me and anybody else that wants to use it. They are the perfect sentiment indicator. They're the perfect sentiment indicator. You don't need anything on your chart. Nothing. Except for what you're going to trade. And if I have an opposing, myopic, retail logic trader telling me in the public eye that they believe that this is going to happen and it's diametrically opposed to what I anticipate in price action, oh, yes. Yes, indeed. Yes, ma'am, I'm taking that trade. Yes, I am. Now, is there a moral dilemma there for you? Because I don't feel it. I have no qualms about that at all. None. Why? Because I was just like those people in that chat window. When I first started, I had no idea what I was doing. I had my head up my ass. I thought I knew everything by reading a book that had nothing to do with why price moves. It was based on classic bull flags, channel breakouts, all the bullshit that people read in John Murphy's book, which is the Retail Trader's Bible. You should all read that book and do opposite of everything it fucking says using when I tell you to trade. If you do that, there you go. Buy one book. It's the Technical Analysis of the Financial Markets by John Murphy. Buy that book. Okay? Buy that book. Pay that man his due for writing the book. Okay? Don't go on the internet and get the PDF file. Okay? Do this. Read it. Know what the retail trader is going to be thinking. And couple that with how I teach you how price will book price. When they're diametrically opposed, you have a 90% likelihood that your trade's panning out. Now, that's not a 90% likelihood that your target's getting hit. It just means that it's going to move opposed to what they think is going to happen. And that's a challenge for you. That's a challenge for you to go out there and see if what I just said is real. Because if it's not true, you're going to know right away. And there's no need for you to go any further in listening to me. But that's what I'm doing all the time. I'm doing that very thing. I look at where people think is resistance and support. I run right through it. I'm a battering ram. There it is. I'm smashing through it. Because the orders that are resting around that level, I want that. I want that as my exit, or I want that as my entry, because I'm going to then target the people that are doing what? They want to see a breakout, and they want to see a continuation going lower. Well, I'm going to trade against that. So I'm going to use, based on what my understanding about, or narrative about what price is likely to do. I shared it this morning. It's on Twitter. Not Twitter, good grief. Creatures of Habit, right? It's on my YouTube community post. I said, note this, okay? You got to click on the chart for it to maximize and show it to you, but it's the 16,208.50 level. And when I started this live stream, I said, just so you guys know, I still believe that this is where we're going to draw to. Okay, but on the grand scheme of things for the week, I think that we're going to reach up to here, and it may need CPI to get there. It may not. If we move quickly away from it and we trade down, into in this range in here prior to CPI, like in other words, if we trade down and we get into this area here prior to right before 8 o'clock, 8:30 tomorrow, where CPI number will be released, then it's 50-50 for me. I don't know what it'll do. Okay. If we are high up here like this, then I would expect it to drop heavy, then reverse, and then rip up here. That's what I would do. If I was making the market for indices, or especially for NQ, that's what I would do. I would use the first impulsive price leg of CPI, let everybody think it's a short, and then come back up here and smash these guys. That's how I would do it. That is not a trade advice. That's not for you to go out there and trade ahead of CPI. It's not for you to trade after CPI number hits. It's just, that's a scenario in my head right now looking at the chart. Is that the one I'm going to trade tomorrow? No, because I'm not trading CPI. Okay. So there's a lot of, this is what you do to learn. You have to have experience, right? You have to have an expectation of what you think price will do and how it should behave and what it should not do. And over time, which is what you don't want to submit to, you don't want to put time into it, years before you get excellent at it. You want to be excellent right away. You want to have it your way mentorship, a have it your way mentor that tells you right in 5 seconds, in 3 sentences or less, how to buy and sell, how to place a stop loss, how to manage the stop loss, how to get a partial target, and never lose money. Now, the people that have traded for a while, you're laughing your ass off with me right now because you know exactly that's exactly what this world today right now wants. Everybody that comes into trading, that's exactly what they believe is possible to be handed to them. And I'm telling you, you're full of shit because that doesn't exist. There's so many things. You're asking all the time when you see examples. How am I having a stop loss that's that tight? 30 years experience, losing lots of money, blowing lots of accounts, learning from those lessons. And I understand, even learning those lessons, there's no way for me to condense it. Like all these jokers out there say, you talk too much. You could have said all this in less time and you would still know nothing afterwards. So what's the point? I'm teaching because I want you to learn. I'm doing this for free, folks. Okay? I don't need to be here, but I love it and I miss it. And I want you to succeed. I want you to see what I'm showing you. It pans out. It pans out. It pans out. It pans out. So if I can do it and I'm using the logic and the tools that I've made available for free, what's preventing you from doing it? Experience. So get your ass busy and getting it. Get that experience. All right, so let's get through the brass tacks of this. It's about lunchtime. So at 8:30, right here, that's when the market's going to start doing what? It's going to start going towards the pool of liquidity that it's going to aim for. So at that 8:30 time window, we've already arrived and determined that we've already done damage down here. So there's no need to come down here. This is the safe house. This is where all the little lambs feel safe. Okay, so the wolf has already smashed through the grass house, the wooden stick house, and here's the brick house up here. So they think they're safe. All of them piled up in here, laughing at the big bad wolf. They're never going to get me. They're never going to get me. And they're hanging down in here. So 8:30, we see it starting right there. It starts moving. We break out of this little area here. I'm not a breakout trader. Then it comes back down. And then right at 9:30, no escape. Little pig, let me in. Smashed. Bacon for breakfast. I don't eat bacon, by the way. So we ran through it, took them out, and then for good measure, ran deeper. Come up to this level here, and then started pulling back. But ICT's wrong. I know you were hoping that level I posted this morning, so you can go on social media and say, look at this level. He called and didn't even trade there. Where's your post at? Go ahead, just post it now because you had it set up waiting to do it, but you got denied again. Just like it'll be all year long next year in 2024 in the Robbins Cup. So because we failed to get to it there and we pulled back, we didn't trade to the top of that candle there as support after resistance broken would become. You're denied there. What is it really doing? It's trading in here for an institutional order flow entry drill, which is this little candle low here. It's part of this. Okay? I'm literally teaching you exactly what the fuck my books are going to talk about. So don't buy my books. I don't need your fucking money. I'm only putting it in print so that way everybody knows it's my shit. Because all the books out there right now are teaching in partial format. They are not complete. You don't know what the hell you're doing at the end of it. It's just me being parroted. So take this off for a second. This rip right here at 9:30. What time? 9:30. What time, ICT? 9:30. What time do these moves begin and run, ICT? 9:30, 8:30. This is not the first time I mentioned it. It's not the first time I mentioned it, folks. It's not cookie cutter. It's not, oh, he only talks about it when it works. It's the same shit every day. It's always the same way. It's always the same way. So what did we arrive at? We arrived at there was no necessity for the market to go lower. It would, in fact, run here, but not just simply there. I was watching live streamers, and I'm not going to say their names. They had a long one, and they stopped holding that long prematurely before it even got above here. And I smirked to myself. I'm thinking to myself, wow, they're going to be mad. They're going to be mad in a couple minutes when they see that thing start fucking tearing ass. And it did. That's inexperience. That's all it is. And it's easily overcome. It's easily overcome. But at 9:30, that window of time, right at 9:30, what's actually occurring? I'm going to go down into a 1 minute chart. Let me put that level back on here first. So here is that pool of liquidity where buy side liquidity or buy stops are resting, and these levels are obviously what I've already outlined here. So this is the daily objective, and then for the week where they would run for liquidity for the purposes of going against the large funds. Okay, so this is not a one-time teaching. It's exactly what I was teaching last year. Okay, and this is exactly what I taught my paid mentorship students. This is the same logic. I'm not morphing into something different. I'm not trying to make it complicated. This is simple shit. It's really, really, really simple. But now we're going to drop down into a 1 minute chart and look at this 15-minute candlestick over the course of individual 1 minute candles, okay? Do me a favor. If you are learning from this today, I would greatly appreciate a thumbs up. It doesn't cost you anything. I promise you, no one's going to know you like the video. It's completely anonymous. But it encourages me because sometimes I've asked for this and I look at it and I'm like, wow, I literally just gave you something I used to charge people $20,000 for, and you literally can't click the thumbs up as a sign of appreciation. That to me is entitlement. That to me is absolutely entitlement, and I don't owe you any of this. And while I don't necessarily need it, it's just astonishing to see a video get 185,000 views and 5,000 likes when I'm inviting you to do something as a means of encouragement. Did you notice how I slacked off doing it? It's because of that. It's because of that right there. And there's a lot of people that do want to do it. That's great. But I'm looking for a movement here, not just lukewarm response. All right, so we're in here at 9:30 is right there. So I'm going to zoom in so that we can see it. But here's that sell side. We will have to worry about it. We don't need to worry about it. Why? Why aren't we worried about it? Why aren't we worried about these relative equal lows, ICT? Why aren't we looking at this 1 minute relative equal lows? Why didn't the market go down there? I can't hear you. I don't see any comment that some of you are asking that. Maybe you did post it. Maybe you were planning on asking about it. Maybe you're smiling thinking, yes, that's the question I was going to ask, or that's what I asked and you haven't got to it yet. Everything I've outlined in the first part of this presentation is there's no need for it to go down there. The path of least resistance is where the largest pool of liquidity that has not been tapped into resides, where the smooth edges are in price. We determine that from the 15-minute time frame. So when I'm looking at a 1 minute chart, you think I'm turning the chart on. Oh, he went right to a 1 minute chart. He can just look at the 1 minute chart and there it is. No, I'm at least looking at what I thought was going to be pertinent for the week. That I did the analysis on a day when the market's not trading, Sunday or Saturday or Friday evening when the markets are closed. So I'm looking at the weekly chart and I'm spending about 5 minutes determining, okay, it's likely to keep running higher to run an old high or go into a fair value gap. Go back and look at your own weekly chart. Was there a fair value gap that it needed to trade up into? No. So what is it? It's the highs. Real simple, isn't it? Isn't that simple? But what happens if there's an inefficiency or a fair value gap prior to that high? Well, then I would use the inefficiency. That would be the weekly objective. This is too hard. I don't know what to do with this stuff. This is too many variables, ICT. Bullshit. You just simply aren't taking notes, and you're complicating it. If this was complicated, it would be very hard for me to continuously keep using different models all the time and still make it work for you. Think about it. All of these models are available to you for free, but not every one of them are going to fit you like a glove. You'll have one that works perfectly and maybe an extra that if that model doesn't exist, there's something else you can lean on. And if you can't find it in one or two models, then that's a perfect excuse for you not to be trading today. Don't force it, turn the charts off, and go do something else. How's that for logic? But no, that's not going to be what you do. You're going to find some reason to get in there. You're going to look at relative equal lows like this and say, no, I think it's going to go down because look at it. Look at this. Look, it's making a bear flag, and so it's going to drop down there and bullshit. What is it really doing? What's it really doing? It's only trading to the midpoint of that consolidation I outlined for you right there. Perfect. Are any of the bodies closing below the midpoint of that consolidation? No. What do these wicks reach into? That volume imbalance between these two candles' bodies. See that? Oh, it's going to drop down. No, it's not. Because the unfinished business is this level here, which is those relative equal highs in that 15-minute time frame. And by the way, the other video I did prior to this one, I listened to the playback 2 days ago, and I actually call the highs. I said these are relative equal lows, but they're highs. Oh man, when I saw that, my OCD flared like crazy. Like, fuck, I can't go in there and fix that. And it's driving me crazy. How many people looked at that and said, "ICT, what are you talking about? They're highs." But it is what it is. I mean, that's how you get it from me when I don't have a script, and I don't operate on a script. It's as it happens. So there's no need for it to go down here based on everything I outlined prior to where we are right now. So we're dropping down to the midpoint of the consolidation. And as price drops down into that midpoint, you're going to be anticipating a price run. You're anticipating it ripping higher, and you want to look for reasons to get into the move. And if you're undecided, okay, my son asked the question, well, can you start, because what if it goes into something like this here, right ahead of 930? What if it does something like that and then uses the top of the consolidation but trades into a fair value gap like that and then keeps on going off like that? Well, then that means you'll miss putting on the largest portion of your trade. You might just get a small piece on. But using that question that he presented to me this morning, I will present to you this. So we're inside, trading in here, into this fair value gap here. I'm using that logic with this movement here, and then using this as an inversion fair value gap. So that was what I was telling him at the time. I said, okay, well, you can get a small piece on. Don't look at the contract size. It's irrelevant. Okay, this could be just one contract. It could be 50 each time. It's irrelevant. It just so happens that when we were working together with it, and I don't want you to look at counting all the money up because it's demo. It's demo. Okay, the logic is, how do we scale in? And every single time we traded to a specific PD array, I told him, press the button now, press the button now, press the button now, press the button now. And I was telling him every single time he did it, I said, now this is what we're using, and this is what we're using, and this is what we're using. So he was seeing the pattern formation being brought to his attention by me at the time. He was pressing the button. So he was having the engagement and the memory of, I see this happening because Dad's pointing it out. So he's going to hear my voice in his memory. He's going to see the chart because he's going to remember it by repetition. This is how I teach my kids, by the way. And he's doing the process of him pressing the button. It's not him watching me press the button. Notice this, because many of you that watch my videos think you're learning. No, you're becoming familiar. That's all you're doing. You're becoming familiar with it. It's the equivalent of you watching someone else do a workout in the gym. Oh, wow, look at him. He's bench pressing 600 pounds. He's doing, yeah, oh, man, that's great. I went to the gym today. No, you didn't. You didn't do shit. You ate fucking bonbons and potato chips, drinking root beer, watching somebody else bust ass and getting the weight lifted up, throwing weight around. You didn't do anything. And that's the equivalent of people that come to my YouTube channel and they watch my videos, but then they don't do anything I tell them to do in the videos, which means you have to go back through the price action. You got to back test. And then you have to study and then do forward testing. Eventually, when you get through tape reading and you get familiar with reading where the price should react, and you're not pressing any buttons there. You're just watching price, getting a feel for what it's likely to do next. And there's no dependency on you being right or wrong, not even in a demo. Because if you jump to that stage before tape reading is done and you get good at reading price, feeling like it's going to go to a specific level, then go from that level to another level, that's tape reading. Okay? Fuck all you guys that are talking about, oh, that's not tape reading. You don't know what the fuck you're doing. You have no idea what you're talking about. You're talking about level 2 data bullshit. That is irrelevant, spoofed bullshit. It has absolutely no bearing on why price is going to go up. None, zero, zilch. But at some point, when you get good at reading price real time and you know what it's likely to do, then you go to the stage of entering. But you have to go through that process of getting through a period of uncertainty and not trusting your own executions. And since he asked about consolidations, just so you know, I'm telling you, don't trade like this, because this is the highest complicated fucking way for me as a mentor to try to teach this part to you. But I'm going to share it with you how I taught it my son this morning, okay? Trading in consolidations is very tricky because you don't know, and I don't know, if they're going to go in manually and intervene and rip the other side of that consolidation one more time and then send it hard the other direction. But if I do take a trade, I'm going to teach it in a way where it didn't happen today, but I'm going to tell you, in the event, if I ever trade like this in the future, and you probably have seen examples of this in the past. I was on baby pips. I did it a lot with Forex. But this consolidation here, how we moved outside of it, we were using this gap here, and we already worked into this one. So this had already traded down. I'm going to take I'll put these back on in a minute, but I want to go in and show you what I was pointing to him. All right, you see that small little gap right in here? Let me elongate the chart. See that little separation right in here? See how the bodies worked just inside that? The wicks went past that, that's fine. But the bodies are stopping right in there. That to me tells me that it's already building the narrative that it's going to go higher. But what it creates here is a pool of liquidity for sell side. Meaning that if it's going to do this and go higher, if it goes back below that, okay, that's fine. It's going to do what? It's going to pull back to the middle of consolidation. And what's at the middle of consolidation? Look over here. There's a separation of these two candlesticks bodies. Yes, we have a wick right there that connects this candle and the candle previous. But there's a separation there, and I teach that as a volume imbalance. Because I teach that the volume of the move is seen in the body of the candlestick. So if there's a separation of two consecutive candles where they may overlap or connect with the wicks, but their bodies don't connect, there's an absence or imbalance of volume there. So the algorithm refers back to that. That's what you're seeing right here. But no, it didn't. Look at it. Look here. Here's the low of that fair value gap. I'm sorry, volume imbalance. It went past that. Right. And you're not paying attention to the volume imbalance that's right here. That's what it's digging down into perfectly. See that? But the real work is this, determining that, yes, it can reach for these areas here, but the narrative is not changing. It's not a bear flag. Why? Because none of these bodies are closing below the midpoint of that consolidation. You see that? So as I'm watching this, I'm telling my son, look at the bottom. Everything I type out when I'm looking at the examples and I'm doing live executions and I'm typing out the narrative, I'm typing out what I think, or I'm drawing attention to watch the candles bodies, watch the bodies, watch the candlestick bodies. Or if I'm talking about something when I was doing live tape reading with you, Austin, now watch the bodies, keep your eye on the bodies. The wicks can do all the damage. At some point, this candlestick was a bold-faced bearish candle, and it was right on the low. But then it changed. I'm watching these candles as it trades down into that midpoint. I'm not concerned that it's doing it. It's expected to do that. So my son's question was, how do I, if I see it do this and it trades to here, can I buy it? And if it just goes to the top of that consolidation, what happens if it does that? Can I do that? Yes, you can do that, but you can't build your largest position there. And you run the risk of entering, and then if it takes off like this, well, whatever you got on the trade is all you can do. You may not get an opportunity to pyramid anything else in. So that's what you run the risk of. The deeper you can trade inside of that consolidation, ahead of what time? 9:30. So what side of the marketplace was likely to be traded to? The buy side. What specific levels? 16,280.50 and then, or I'm sorry, not 280, 208.50 and then 264 something. Yeah, 208.50 and then 264 whatnot. So in here, as the market's trading down into this, every single time it's digging in towards that halfway point here, I'm telling him, press the button, press the button, press the button. And he's scaling in because I'm teaching him to see what it feels like to be buying it when it's dropping. See, for some of you, when you watch me take trades where I'm buying below old single lows or relative equal lows, that's a trade you won't take because you have never conditioned yourself to anticipate that it's going to be doing that very thing. It's scary to you right now, even in a demo, because you don't like the response of that result being adverse or not profitable for you, or the outcome not favorable, or something you can brag about on social media. Look at this. Or feel good that you did something right, because you're worrying about being right or wrong. And when you're learning, it's not about right or wrong. It's about learning a process. That is not an absolute profitability. It means that there's a gray area that you have to willingly embrace. And trading is all about that. So by doing these types of examples, going in, and I'll give you some, right now, I'll slap some down right now for you. Every single fair value gap, whether you can determine the bias or not, every single fair value gap on a 1 minute chart, you should engage. Not holding yourself to being right or wrong. But when you see it and it trades into it, for instance, right in here. See this buy side imbalance, sell side inefficiency, that big green candle here? When is that occurring? What time is that? 9:33. What is it running towards? What direction? That blue line here, which is that 15-minute relative equal high, the buy sides, or where I told you it was like a safe room where the retail thought it was safe to be there with a short position, having a protective buy stop in that area, right above that. Well, at 9:33, it in one single candle, it ripped from here all the way up here, but stopped short of it. The next candle, it opens, sweeps it, and then digs all the way back down to what? To reprice to this candle's high and rebalance all of this inefficiency that's created by that one single up close candle. So that buy side imbalance, sell side inefficiency, it is a fair value gap, but what is it inefficient in? Movement delivered to the downside. So an efficient market delivered price is where price has been offered on the upstroke and on the downstroke, because it's giving both entities in the marketplace, buyers and sellers, reason to employ whatever logic they have in the movement of price. So as price is going up, oh, it's buying pressure here. Bullshit. That's not what's going on here, okay? Because these orders were already sitting here right above that high, or above the 15-minute highs, okay? Remember, for some of you that are brand new, I probably lost you. I'm going to go back up to a 15-minute chart and come right back to this chart here. But the 16,118.75 level, what is that level? It's this. It's these highs right here. See the price, 16,118.75? That's these relative equal highs right there. So it runs real quick to get those. It doesn't take a lot of contracts being bought to get there. If there was a handful of orders coming in, okay, at 9:30, there is a plethora. There's a huge injection of market orders coming in, flooding the marketplace, buying and selling, buying and selling, buying and selling. The algorithm will reprice and keep offering higher prices. It doesn't fucking matter how many people are selling short. It doesn't fucking matter how many people are buying it. It matters not. It just needs people to come in so it can book that price. And when that price is booked, the candlestick, your chart, the market itself will reflect that, because it's being controlled to go right into here. And then the real party starts. What's happening? The market has now brought in traders that are thinking what? They're short. Now they're stopped out. Are they thinking about doing a short again? Hell no. They're like a deer in headlights. They're scared to death. They're stopped out. They're wrong. What the hell's going to happen today? I don't know. And then it drops aggressively. What's that doing? Enticing them to get back in. So what are they going to do? They're going to sell as it goes into this inefficiency. Exactly when smart money is waiting for price to go right into this little area between here and here. That is being done by the algorithm to offer the opportunity for smart money, people that are looking for these types of setups, when it trades down there, they're trying to accumulate and buy that. As retail chases it going, oh, I got stopped out. It's going now. Yeah, it's going right back up to stop your ass out again. Because you're trying to force your will as a retail trader. You don't know shit. You don't know anything. You're completely a neophyte. But you're impulsive. And you can't accept being wrong. So therefore, when you trade, you're putting everything behind the trade. Reckless abandonment. You don't care. You're right. The market's going to listen to you. You read 16 books this past summer. You know what you're doing. Well, I'm teaching you what the market's actually going to do. Why does the candlestick close? I know some of you think, well, look at that. Wouldn't you be scared by that? No. Why is this permissible here? Because all of these candlesticks here have wicks. And what are they? They're gaps. Just like this is a gap. So inside of these individual wicks, we can expect, oh, it can dig down into that. How far? Well, we just left this consolidation. Didn't it just trade down into that? Yes. But is it closing inside the consolidation? No. So the bulk of buying would be done in here, and you'd have to let the market trade against you on that new pyramid entry, or if that was your entry to get into it. Now, find the books that talk about that. They don't exist. They don't tell you where you're getting in at and how to be comfortable in drawdown initially while you're in a trade. I've never bought a book, and I have over 2,000 of these fucking things, both in electronic format and actual hard copies. Not one book I've ever bought taught anything about when you get into a trade, how much it takes to hold into a trade while you're in drawdown before your trade starts to pan out. Not one author has ever touched on that subject matter. And that's the very thing that caused me to fail when I had winning trades, but I couldn't hold on to them because I was scared, because I was afraid to take another losing trade. And the way I teach is you need to do these things with a demo that has a purpose for you doing it. And back to what I was saying, a drill, a way of overcoming fear, a way of getting yourself pseudo experience. Every fair value gap. Okay, let me widen this because it's not as clear as I want it to be. There you go. So between this candle's low and this candle's high right there, that one single green candle, that's inefficient. So if we believe that this is just the first part of the run up, and remember, we're still looking for price to get up to here, 16,208.50. I told you that this morning. Well, if it can do this, come back down and trade into this inefficiency, and we already feel confident that this was only getting down to the midpoint of the consolidation. We didn't need to go down below these relative equal lows. Why? Because the premise in the narrative was it's going higher. So there's no need to fear about it's going to go below that low. Why? It didn't go to the 208.50 level yet. It's so close to that level in the daily chart, they're not going to leave it there. Why? Because contract rollover. They're not going to let them sit there safely right above that high. They're not going to do it, folks. They're not going to do it. And did they? Fuck no. Nope. And you're all here live. This isn't a recorded video. I've explained this ad nauseum. Maybe not with the best choice of vocabulary, but it's emphatic. I'm being emphatic about it because I want you to understand that these things repeat because they're coded to do this. They're coded to do these things. And when this rush of volatility that comes in and order flow, the buying and selling that's coming in, it doesn't matter how many contracts. They just need a contract to book a price. And as it goes higher, the next price that's offered, there's people coming in all the time with market orders, all the time. You could have a flood of short selling orders coming in. It's not making the market go fucking down because they're going to keep offering it higher, 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 higher. You ever been in a short squeeze? You're short. What do they keep doing? Pricing higher, 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 higher. Look at the volume. It's not much buying. Look, you want to look at that ladder and that depth of market bullshit? Level 2 data? Look how many contracts are really fortifying that rally. Perfect example here for commodity traders. How many contracts does it take to create a limit up or a limit down day? Some of you don't know what the fuck that is. But there's a day where the market will open up based on the previous day's close and where we open the new day. The opening price is the entirety of that daily fluctuation. It's at the maximum movement it will be allowed. And it stays there, locked, limit. What? Yeah. I got stuck in that once before. That's not fun. But I also had days where I was stuck in it moving in my favor. Both instances of that is terrifying because you can't get out. You cannot get out. There's nothing that will allow you to get out of that trade. And that, my friends, is fucking terrifying. Even when you're making money, it's terrifying. And worse so when you're losing. And in your mind, you're thinking, shit, it's going to do 57 days of this. So astronomical in terms of exaggerated expectations, right? But that's exactly what it feels like. And anybody that's been trading commodities for any length of time, that's ever been in a limit up move or a limit down move, and it's been an adverse side, like if you're offside, you're not on the right side and you're losing money, that is a sick feeling because there's nobody to help you. And everybody becomes a Christian then. They start praying to God they never believed in before. Please let me get out of this, right? But every time you see a fair value gap and it trades down into it like this, it's irrelevant whether you believe it's going to go higher or not. If it does this very thing here, press that with your demo account with one contract. Just one, not 50, not 20, not 19, not 40. Just do one contract. Get the experience of what it feels like to go in there as it happens and just watch the reaction. You're not using a stop loss. You're not using a target. You're just engaging that fair value gap. And it gives you experience of seeing it. I've done this for weeks with my son. And that's what helped him find fair value gaps. I would see him using my experience. I'd say, okay, use your finger on the buy button. He'd be sitting up here like this. And I'd say, okay, and push it. And as it's going down here like this, he pushes the button, and then he gets the fill, and then we watch it. Admittedly, I'm telling him just watch trade right back to that high. In and of itself, that right there to here, that's a meal ticket. Like that's a model. That's easy winning a combine. That's easy getting paid out. That's easy replacing your fucking job. That's easy getting rich. That's easy winning the Robbins Cup. That's easy fucking becoming a millionaire. It's easy fucking telling Tom, Dick, and Harry's mentorship to go fuck yourself. I'm not sending you any more money. But you want to do those things because it's a sense of community. Go fucking join a gym, okay, and get something better out of it. There's a community right there for you. Stop feeding these people. They're parasites, okay? You can do this on your own. It just takes time. You got to work towards it. It's going to take effort, and it's not going to happen overnight, but it will work if you put the effort into it. Now, let me add those executions back because I want you to see where I was in this. So I told him initially when we were up here, working off the top of that initial consolidation, if it takes off right from there, because it can do that, you just put on a small piece, okay? And because I'm teaching him just to press the button, the numbers of the contracts is irrelevant. When you practice, just use one. Don't try to do more than one. It doesn't matter how many contracts. You're just trying to engage it, okay? It just so happens that it was set on 5 like it is normally here. And every time I told him to press the button, this is the reaction. I wanted him to see what it feels like to push the button. The numbers of what these trades add up to is irrelevant because that's not the point here. The point is engaging as every time it trades down into this area here, you want those very things. And you can see the prices. And then ultimately it trades up. And when it trades up into a point where it offers you a sense of accomplishment, like I want to teach my son how to take a low-hanging fruit objective because he's literally 16. Like he's so new that he's equivalent to someone that just said, "Oh, trading? Let me go see what that is." And he's my son. He's heard about it all his life, but looking at it on a chart, he's got a learning disability, so I have to do what I have to do with him in a way that I feel confident he'll grow. And in the last, I guess, 3 weeks, 4 weeks, he's shown understanding, a small growth, but it's going to be a long process for him where, some of you learning from me directly would probably take a couple of weeks, and you'd be able to do everything you need to know and find a model, and there it is. But for him, it's gonna take a lot. So for him, I have to teach it to him like he's playing like a video game. Okay, and I give him discussion points like, okay, now see this level here. Now think that that's a fort. Okay, and you have a fence right there, and below this area here, there are people that have gold, because he plays a lot of games and such. And as it drops down there, I want you to think that you're going down there to get their gold, and you're going to run away with it. So that's the analogy I use. He's 16, but he has the mentality of someone that's like 10. So that way you kind of understand where I'm coming from. So when it got to here, I said, you want to think about getting out with these relative equal highs. You don't need it to go above those highs. But because they're even, it's smooth. It's before we get to that level up here, right? So it's important for, if you're going to buy down here, pay yourself something easy. That level is 16,095.50. So as it's trading up there, right there, you see a little arrow here that pops out, I guess it's called a carrot. That little thing right there pops up just below my cursor. That's the actual exit. And that's what I was teaching. I said, as it's going up there, you do not need it to go above that to make money, to be right, to have a win, okay, to get a high score, that type of mentality. It's better if you can time it when it goes up there, but as it was going up, that's where he decided to push the button. Okay, you all know that it would be me reaching above this, and there it is. But that's him pushing the button to give himself his first win. And when you see that happen, and he smiles, and that sense of accomplishment, like I did something, right? He didn't really do anything, but he feels like he did something, and that's the encouragement. And that's the same thing that you have to do as a developing student. You got to reward yourself. When you sit down and you practice, you got to have something to measure your progress. And just because it's a demo account, okay, or a paper trading account, don't read into that and listen to these fucknuts, okay, these jacklegs on the internet say, oh, it's a demo account. Motherfucker, listen, I pay more taxes in one fucking quarter than you'll make in your entire fucking life, your entire family, in one fucking lifetime. So please save your bullshit, okay? I'm teaching something that will make many people wealthy, but you don't need to be wealthy. If you just make your ends meet, that's a success. And that's where I aim. I aim for that. So you have to graduate in your understanding. And most of you can't imagine making $1 million. You can't imagine it. It seems unfathomable to you. Right now, you're thinking you can't make $1,000 a month because something always happens where you lose. The way you get there is doing these types of things. You have to do things modularly, smaller, little incremental steps where you feel rewarded by doing so, but it cancels out any chance of any adverse reaction or losing money, because those things, even if it's a small amount of money that you lose, they cut deep. They cut deep. And you got to remove any possibility of that happening. So anyway, we have the 16,118.75 level. I was confident before I had to leave the house to go to get to his 10 o'clock appointment that I could finesse that. Okay, so I told him, I said, we're going to put limit orders in, and we're going to stagger them all above this level here, but we're going to leave one where it reaches for, well, I don't know if that's the actual order, but I sent a screenshot on the community post where you can see the actual limit orders that were resting in the marketplace before it spiked up like that. But then it dropped down in here. If I would have been home and not in my car driving him, I would have went in and told him, now buy it once more here, and then rallied up. And I would have told him, use half of this. I hope I can talk like this to the real students here, because I know sometimes, because I actually didn't do it here and because I'm not actually having an entry over here, it seems like, oh, this is hindsight. I'm telling you in hindsight, but with a great deal of surety that I would have absolutely fucking been all over this like white on rice. I would have bought that, and in the middle of this wick, let me take these line things off, okay? See that wick right there? See, when you see these types of things, you think Steve Nielsen taught you that's a doji, or that's something that's building up bearishness. Fuck that is. This is something I'm looking at. I'm going to buy it because it's a gap. So how am I going to treat it as a gap? Here's the low of the gap, which is the open of that candle because the down close candle, and here is the high of it. What's occurring around the 50% level of that? It's accumulating what? What's it accumulating? New long positions. Who's buying that? My students and people that have traded the markets like I'm teaching you. That's smart money. High frequency trading algorithms are using that very specific price level right there to accumulate new longs. What is it reaching for? A high frequency trading algorithm will buy that level and sell it here, right above that high. If they hold more, they'll sell when it breaks above this high, right there. That's running down equity. That's high frequency trading algorithm in a nutshell. Every single time that the market runs to a new higher high, it's taking something off. As it retraces and goes lower, retail thinks, okay, it's created what? 1, 2, 3 drives pattern. It's going to go lower. The fuck it is. Why? It's going to go up to the higher objectives, reaching up into that 16,208. I can't be in front of the chart because I'm at a dentist. I can't manage the position because I'm going to be talking to this dentist. So I did everything with the setup, telling him place your limit order here, 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 here. And you can see those varied prices on the community post. Okay, before all of these filled, let me put them back on again. They were staggered all above, in here, above that 16,118.75 level, which was the 15-minute relative equal highs that I was teaching in the beginning of this presentation that retail thought was a safe area to have their stop loss. Okay. Now let's go in and talk about why I chose those levels for the limit orders. So I'll take these off. Right? And actually, before I do that, do you see how this right here is the same thing? That's shaded. Let me take this off. We don't need that anymore. This single candle right here, and how it trades back down into it and then runs higher, that's the same thing that's occurring right here. Rallies up, comes back down into it, and then rallies higher. And then it comes back down into it deeper. Why? Because it left this portion open between here and here. The other day, I was showing a trade where I had the opening range highlighted. It was me adjusting to what was remaining in terms of the opening range. The opening range gap is where we open at 9:30 to where we settled previous day. So that's my opening range. And there's lectures that's been presented about it, and there will be lectures taught going forward. But if I confused you, I know I saw a few people post in the comment section of that video saying, why did I have it highlighted there and why not at a higher point? It's because it was already trading lower at the time, and I was only interested in taking the trade when it got down to that lower degree. And just because I'm looking at a position, or let me say it this way, just because you're watching me put on a position and I'm annotating the chart, I'm annotating it based on what I see at the time. And opening range is an evolving thing. Once 9:30 comes and the opening bell occurs, whatever the difference is between that opening price and where settlement was the previous day, that range is going to either reduce and narrow as it starts to close in and fill it, or reprice back to the previous day's settlement, or it stays open and it just keeps on running. So it will depend upon when I sit down and start taking a trade, or if I do analysis, or I have to wait for Camtasia, or sometimes my computer is just like yours, it starts to do a Windows update when you don't want it to. All those things slow down the process of me getting the recording started. And it may not be a time where I have the annotation for the opening range showing the entirety of where it would have been if you watched it right as 9:30 opening bell occurred. So I'm answering that question also too. But this here, don't worry, I did not forget about why I chose those limit orders. But I wanted to throw this in here. But if I don't talk about it now, I will forget this part. This same area here is this shaded area here. The same idea. It's going up, and then it comes back down. Okay, here's another 1, 2, 3 drives pattern. It's gone short. No, it ain't. No, it ain't. That this is an inefficiency. So this inefficiency between this candle's high and this candle's low, it only has one single pass through on the upside. What is it? An up close candle. That means it's a fair value gap in the form of a BISI. Buy side imbalance, sell side inefficient. Meaning it needs to have, in a perfect world, in a symmetrical market, there's going to be a future delivery of price that's going to overlap all of this and come back down in a perfect world to touch this candle's high right there. But what can it do also? It can, because it's a down closed candle, it can trade to the opening of it. Why? Because it's an order block. So it's two things there. It's two PD arrays. So this level closes the inefficiency. So selling down to it. Look at the bodies of the candles. Does it satisfy that? Sure it does. Do the bodies close below the fair value gap low, which is this candle's high? Nope. But what do the wicks do? It digs into this down closed candle. Why? Because it's an order block. So when you're placing a stop loss, you have to confer with what you're trading up against. Is it just one PD array, or is it a PD array that overlaps one another like this thing does? Because look at the complexity of, if you were going to use this as your entry, say this was the silver bullet, because this is exactly what it is. If I was trading this silver bullet, this is how I would have traded it. I would have traded it as it traded right to this low here and touched this. I would have waited to see if it wants to trade into the body of this candle and allowing for, and as much as what? Midpoint of that wick. Why? Because that's consequent encroachment. It could trade all the way back down and touch the midpoint of that. And if your stop loss is just above that, you're getting roasted. And then when it turns against you and starts moving in your favor, you're going to be mad. So these are instances where my stop loss will be a little bit wider than it would be in other instances. If this would have been a bold-faced bearish candle, then I would have only expected it to touch the opening and maybe just below the opening of it. But because it has this wick here, I have to allow for the potential for it to trade down to respect the consequent encroachment of that, which would also upset those individuals that have a stop loss there. It might squeeze them out without needing to trade it below there. You follow what I'm saying? So I act like I'm going to hear you. But the bodies they're telling me that it's not trying to do that now, because we tried to go down there, and then this candle closed. It did not close outside of the fair value gap here. And now we can be long. We can be a buyer. Right as this candle opens up, that's when I would be buying. As early as I can, pushing the button, I'm getting in there. I would, if it was an opportunity for me, and if it was a time frame other than a 1 minute chart, and I had the afforded luxury of using the opening price here, I would have a limit order, and I would place it at that opening price. So that way, if I got that price or less, that's where it would fill me. And then that would be my entry order, and my stop loss would still be just below here, because it could go one more time and create another mohawk, trade below this one, dig into that one, and then rip higher. So I'm teaching you stop management here also today. I'm giving you a fucking clinic for free. You should be thankful. So over here, same thing, same premise. We have a small little gap there. That's what's being respected with the bodies. You see that? But the wick here, half of that right in here, boom, then it rallies. What's it rallying for? It's being drawn up into that 16,208 level. It's being drawn up there. Do you need it? Do you need it to trade there if you're trading the silver bullet? No. What do you need? You need a liquidity pool. This is one on the day or the session. What is this over here? Is this chopped liver? No. There's liquidity resting above that. So if you were trading the silver bullet, going long based on how I would have traded it there, another opportunity right here because you're trading back into it. What time is this? 10:42. Can you trade it as a silver bullet? Absolutely. Because it's not 11 o'clock or after it, right? So that's the silver bullet using the logic and the drawn liquidity I made public to everyone before I traded there. Go long. Push the button as it happens. Put your stop loss right below there. And just see what happens. When it gets here, close it. But ICT, what if it goes up to here or what if it goes past it? Who gives a shit? You don't know it's going to do that when you're doing this. You have to learn that. And in fact, you can see by not taking that partial here, you would miss the opportunity because it comes all the way back down and swipes it. But what is it doing? It's only cleaning up the edges over here. What's this? Relative equal lows. Relative equal lows. This is the old high on the 15-minute chart. If it's support and resistance, this should come down and touch that line. Does it? Nope. But what is it really doing? Cleaning up these relative equal lows. It's trading just below that low here. Bing. Goes back up. Now we're using what? That fair value gap again. That's a reclaimed order block. Reclaimed fair value gap. Difference. There's a difference. It's not an inversion fair value gap. It's a reclaimed fair value gap. It means it's being used again, even though it's wiped both sides of it. The algorithm is going to still refer back to it. Why? Because the underlying narrative has not panned out yet, which is delivering to the buy side liquidity that has yet to be traded to. And now there's larger pool of liquidity because now we have this high that hasn't been purged yet. So this high plus the 15-minute highs, the old daily high, and then we still have the weekly objective up here. So all of these build on context and narrative that helps you keep your focus on what side of the market you're trading on. You're not falling victim to, I don't know what to do, or let me change my mind prematurely and follow somebody else because they're short in the live stream and they're claiming they made money today and let me just follow them. Fuck all that. You have to be independent in your thought process. So when we traded down below those relative equal lows over here, I'll say this and then we're going to go into the targeting. When it cleaned up this area here, what do we get? We have another run up. We start accumulating inside that same fair value gap right there. Nothing has changed on narrative. The only thing that's happened is we traded down to clean up trailed stop losses, which is a convenient way of picking up a discount when you're still trying to get long for higher prices. The market then does what? It rallies up. Does it rip away and take off? No. It goes right back up here and it allows the smart money to accumulate in here. Let's go long. Why? Because it's telling them, look, I'm respecting something that you would have bought already over here. We've already stopped out. This stopped here and all these clean levels here. All of this, then this consolidation sets the tone for a ramp higher. Now this gap right in here. Why did it go here and not go down? Because the narrative is still it's going to go here and potentially up to here. It's bullish. So when we see this, my mind doesn't say, let's go short there. Or this is an optimal trade entry. This is a perfect selling short. No, it ain't. This is an inversion fair value gap. This to here, right over here. Here's the color I always use. What is it doing? Trades back down to the inversion fair value gap and right into this gap in and of itself. See that? All these things build on one another. And as I'm watching price, and I sat with you this past year, and I did live tape reading where I called every single fucking candle on a 1-minute chart. And sometimes I was doing it with less than a 1-minute chart. It was on seconds. And I was telling you exactly how the candle was going to behave. And it behaved. That's experience. That's understanding. That's authorship. That's knowing what the fuck you're doing. But the more important thing is knowing when not to do something and why you shouldn't be doing it. Those are the lessons that I can only give you guidelines on because the majority of the things you're going to do that you shouldn't do are going to be instigated by your own personality and character flaws. And I know you don't want to hear that, but I have character flaws. I've already said more F words in this presentation than I wanted to. I didn't want to say any, to be honest with you. But when I'm allowed to, this is what happens sometimes. And it's unfortunate, but I'm human. And I want you to understand that there's a limit to any mentor. All of us that know how to do something, whether it be trading or whatnot, all of us can guide you and give you the greatest advice that we have for you. And you can do well with that, but you still bring your own emotional baggage and your own character flaws and personality deficiencies. The things that make you derail yourself in everything in life. Your personal relationships, your jobs. Do you have a lot of jobs? Did you get fired a lot? You have an issue with authority? Well, how are you going to submit to a rule-based idea or a trading plan? Think. Like these are real things that nobody talks about in books because they don't want you to put the book down and discuss, because the disgust of you referring and reflecting on your own inabilities to be a functioning adult it's going to make you feel alienated as a reader of that book, and you'll hate the author. And that's why I believe most people that don't warm up to my ideas, they can't get past the fact that I'm telling them they're the fuck up. They're the reason why they can't do it. But I'm being honest with you. If you were my relative, if you were my child, I'd be telling you the same thing. You're doing this. You're doing it wrong. This is what you're doing wrong. You need to stop doing this. Try doing these things to replace that bad habit. And it may not be successful. If it doesn't, I'll try to find something else to replace that bad habit. But you have to at least admit and identify that you have a bad habit that you choose to keep repeating. And every time I blew an account as a 20-year-old, I did the same shit all the time. Just like you're doing it right now. And until someone puts their foot in your ass and tells you that you're the problem, you're going to continuously do it. And every one of my profitable students have come to the conclusion that, you know what, there was a time period where it was me doing it all wrong. And I was trying to force my opinion, my will. I wanted to bring my favorite technique or my faith in something else before learning this and try to move it in here somehow, weave it into the fabric of ICT and smart money concepts. And then when you stop trying to do that stuff and just stick to the rule-based ideas I present, it's not complicated. But it's still very fucking hard trying to do that because it's forcing you to be responsible. And trading is being responsible during uncertainty at all times. Until you get out of that trade with the win, it's uncertain that you're going to go home profitable. Are you comfortable with that? Because there's a lot of people in this world that aren't. But you have to be. So anyway, let me take all this business off because it's a little too much for me now. Where do you think it's going to go? Does it look like it's trying to get up here? It's like a magnet drawing it up here. It doesn't need to get up there, folks. But can you at least appreciate the fact that knowing this level is where there's orders? They're just keeping it going up and up and up. You ever tried to sell short in a move like that? I did. I tried to do that stuff in pork bellies and it handed me my ass. Okay, I didn't know why it wasn't going down. Every indicator I plotted that was overbought and diverged bearishly told me it was going to keep going down, and it kept going up because I didn't know how to trade. That's the reality. And in the beginning, you don't know how to trade, and there's a lot of things you have to learn. But let's go back into this area here. Okay. All right, so we have the orders here where the limit orders were being filled in at. This price leg from here down, you see that? See that right there? If we look at that where I was showing my son, okay, push the button because that way you can capitalize on if it runs away, you have something on. And in a perfect world, this would have been one contract. And all of these would have been one contract down here. But again, don't pay attention to the number of the contracts. It's not about the money. It's not about the size. We're not even talking about that. We're talking about how to scale in and build in your confidence level, how it trades into a specific level with a context and a narrative that the market should deliver a specific direction and a specific price level as an acting draw on liquidity or pulling price in one direction. This is how you submit to those ideas. How do you hold on to a trade, ICT? I have a hard time holding trades, Michael Patak. The idea is you have to have a higher time frame premise, like I've outlined here, and submit yourself to it. If you have more than one contract and you feel the impulsiveness to want to close the trade, just take one off, roll to stop to break even plus commissions, and let it go, walk away. That's the first step. And then whether it stops you out or whether it hits the target or not, you have to be comfortable in accepting that. And the easiest way, and I'm not saying it's easy, but it's the easiest way to submit to it is once you do that and you set your stop loss to break even plus commissions and costs, and you've already took one partial off, you set your target to the 16,208, or if you had three, you take one off at some level here like we did, and then if it gets to the 16,208, you take it off there, and then you leave the one up here. And you roll your stop loss to what you took your first profit just below that. And just let it happen. Accept the outcome. Whatever it is, accept it. Because if you've taken 2 partials, or even if you've just taken 1, and it stops you out, are you a losing trader? Fuck no. Are you a failed trader? No. Do you have a failed model? No. Are you going in the wrong direction? No. Are you adding new equity to your bottom line? Yes. Are you better than you were the day before? Yes. So why are you not doing those things? Instead of saying, and I'm not trying to beat up on Michael Patag, please don't be don't be upset because I mentioned your name, but I've seen it several times, and I see it with every other live streamer that trades, and I see it a lot with my own students that repeat this same question to me. How do you have the ability to hold these trades, for longer periods? If you don't see the higher time frame draw or targets that it could potentially reach for, these are what I call my best case or optimal terminus levels. That means they're literally the best of the best of the best. If everything was perfect, this is exactly where the price would go to. I have to submit to that idea. And while most of my trades don't get to those best case exits because I'm actively managing the trade, I'm taking partials if it's uncertainty, or if it's me teaching, I'm doing partials most of the time as a teacher. Like when I'm trading with a demo, I'm many times taking partials for the purposes of teaching it to you. Because if I'm your teacher, I'm the captain of this vessel, and I'm teaching you as my first mates, hey, I'm the captain. This is what we do. I run the ship like this. And if you want to be a good captain, this is how I navigate. You're going to do what? You're going to take partials too. You're not going to be embarrassed about taking partials because some Yahoo on fucking Twitter that isn't profitable will say partials are not good. When partials 100% of the time pay. They're profitable all the time. There's never been a partial profit that's never been profitable. Okay? So by me teaching you to operate and practice with a demo, and I'm out here in the role of a teacher, furu they call it, a guru, an educator, a mentor, whatever, I'm doing it with a medium that protects me legally, but it removes the stigmatism that is placed around it because everybody else says, oh, it's a demo. But if you're trading in a fucking combine, you're trading a demo. You're trading a demo. You call it whatever the fuck you want to call it, but in reality, it's the demo. I'm in an express funded account. You're in a fucking demo. Okay? It's a demo. Period. The only difference is you paid for your demo. I'm not paying for it. And I'm teaching people how to trade properly. And they're going to that same company or companies like it, and they're getting payouts. So where's the argument here? There's none. So you hold on to the trade based on some level that's above an intraday chart. What is that? A daily chart. There has to be something that you're aiming for. Where do you get that? On your weekend? Remember, I told you my objective for the week was a potential draw up to here. Whether it gets there or not is irrelevant. It doesn't matter to me if it goes there because there's lots of trades I can find throughout the entirety of the week that will have that underlying premise or reason for the market to want to go higher. And it can get real close to it and then fail. It can go to where it's gone today and never go any higher and be done. Does it change the underlying profitability of my executions today? No. And that's where you want to aim for in your trading. Once you get to this point here where outcome is not the result that matters for you, it's this, are you making money? Everybody's opinion about how you trade, how I teach, what I do, what I don't do is irrelevant if you're making money, period. It's about making money. So if it's putting coin in your pocket, who gives a shit what anybody else thinks? Because you're living, you're making your ends meet. You're proving to your spouse, you're proving to yourself, and anybody else you want to make that knowledge known to them that you're a trader, that you can take profits out of the marketplace when 99% of the people that tried can't. And if you're able to take profits out, regardless of the size of them, then you should be encouraged by that because you are in a small segment of this industry because most of them lose consistently. If you're taking money out, you are absolutely successful. And don't look at that and think, oh, I want to race faster to get to a millionaire. Because being a millionaire just means you're going to have more money problems. It's a good thing to have that kind of problem, but it's just more of the same stuff on a grander scale. You buy stuff that costs more to insure. You buy stuff that people want to take from you in lawsuits and they didn't even fucking earn it. You got people trying to drive in front of you and slam their brakes on because they know you have a fucking $100,000 car, and you rear end them. They know that they can get to your bank account. You're constantly on edge. There's fucking ambulance chasers all the time. But this is what you want to chase. That's the lifestyle you want to chase. And you want to promote that you live that way. You're literally a billboard sign. Sue me. I got something to take. And you got to pay for insurance policies like I have to. Several $4 and $5, $6 million insurance policies. If anybody ever does anything like that to me, I'm not getting sued. The insurance company's going to pay out that. I still keep my assets. But it's still something you always have to worry about. So, image is nothing. Opinions of others is nothing. Are you making progress? And does that progress lead you to profitability? That's what you're trading for. Okay, that's what your focus should be primarily on. Now, if you look at this price leg in here, okay, I'm going to take those little entries off. We're going to save this part, and then I'm going to close it because I'm hungry. This price leg here, from here down, okay, from here down, you want to take your fib. We're going to use the wicks first, okay, up to here to here. There's your first standard deviation, -1, which is a symmetrical price swing that is this low to that high, projected up. So how high would you hold your limit order if you're buying down here? Where would in a perfect world, where would you place your first limit order in as a partial? At that level, minus 1 tick, which would basically come to that same level apparently. It's real close to it. Or not that close, but it's closer than this 120.25. So your limit order would be at 16,120 even. So if it trades at that level here or higher, it has to go higher actually to get the limit order to kick. But once it does that, your partial will be taken, and then you can roll your stop to cover costs and be completely disconnected from the outcome because you've paid yourself. If you're going to use the wicks, which is the bulk of the volume, highest up close or opening. Same thing here, lowest opening or up close. I'm sorry, the lowest opening or down close. And we're using that one right here because it's lower than the opening of this candle. Same idea, projecting. So if you were using this, you can't place your limit order here. So I'm showing you both ways because this is what I do myself in my own analysis. 1.5, 2. So looking at this like this, you think to yourself, okay, well, I know that there's a staggered level of potential fib levels that I use as targets. The fib is just a way for me to come out with a specific target that I can come to the conclusion, not put a lot of thought behind it. It's above a level I'm reaching for. It allows me to go to it, and it's something I'm repeating over and over again. The process is never changing. I'm admittedly not satisfied with the outcomes sometimes because if I finesse it manually, sometimes I can do a better job. And other times I wish I would have stuck to the fib instead of doing the manual. So I wrestle with my exits. It's always been my weakness. I've never been satisfied with it. My entries are absolutely stellar. I have no issues with it, absolutely one bit at all. But my exits have always been a source of contention for me as a trader. And I'm saying that, admitting it to you, but I don't want you to look at this and say, well, let me be very harsh about myself and beat myself up when I don't do something right either. I'm just admitting my frailty as a human being, that's the struggling point. Even after 30 years, I'm not satisfied with that measure of precision yet. And I've basically came to the conclusion that the way I use my fib and come to the targets, using it as a target beyond the liquidity levels I'm looking for, that would be aiming for it anyway, that's what I come to. And I say I have to submit myself to this. And the few times that I am a deviant and I go outside of that and try to finesse it and do better, I many times regret doing it and simply wish would have just done the fib levels and then stuck to that. So I'm sharing something that Unless I told it to you, you wouldn't know. But I say it in a way that way it encourages you, because you're going to have a frailty. It might be your entries, and you might be better at exits than I am. That's not anything that I feel bad about. I'm convinced if I live long enough, some of my students are going to have a better exit strategy using what I do. And I may adopt it. And if I did, I would come out and say, I have chosen this, and this is my students, working in that area, much like Larry Williams presented the problem for himself. He didn't know how to buy below the opening price. He only bought strength. After it moved above the opening price, he used 20% of the previous day's range, and that's where he was entering. To me, that's fucking stupid. That's nonsense. You're buying at a premium, and you're guaranteeing you're going to have to go through drawdown. Not all the time, but most of the time. You're going to have to sit through it, drawing back into a fair value gap or running back an intraday stops. I don't like that. I don't like that at all. I want to be buying when it's dropping. I want to be buying when it's going down below an old low or down inside of an inefficiency, a fair value gap. I want to be selling as it goes above an old high or goes up into an inefficiency or a fair value gap. That's how I trade. I want the best of the best. And if I'm long, I want to be bullish. I want to get in before it goes up. I want to be getting in as it's dropping. And when I was a 20-year-old, I didn't have any comfort in that at all. None. I didn't feel comfortable with that at all. It took a great deal of work to get to that. But anyway, I had to work out all this stuff prior to getting to a 10 o'clock appointment and drive time. And that's what we built this morning. So in and of itself, that's enough for all of you to be finding profitability, finding your way to the other side of the pursuits of being funded or not. And let me just compare and contrast real quick. Here's the NASDAQ and the ES. Both those highs are there. So I wouldn't expect it to completely break down. I'm not saying it can't break down, but I'm not saying that it should. Yeah. This is probably going to be one of those little sloppy, just keeps driving higher into the afternoon today. Same way with NASDAQ. NQ. Yeah. There's a fair value gap in there. Trading right inside of that still. It would need to take out. It would need to go on a closing basis. It would have to show a 5-minute close below this low here for me to change my opinion about where it's going to go up to here. If it goes below here on a 5-minute closes, then I don't know what it's going to do before CPI. But until it does that, I would still hold on to the idea that it's probably going to reach for this before we get to CPI. That's how I would interpret it. And I'm not saying you should trade that way. I'm not saying that this is what's going to work out, but that's how I would internalize it. And the reason why 5-minute is because 1 minute's just too narrow and too tight, and 5-minute would be a little bit bigger time frame for me to stick with that narrative in mind. And I think, my friends and neighbors, that's going to be it for today. I gave you a really good. I would have paid money for this. I'll be honest with you. I ain't gonna lie. I would have enjoyed it. But ES, real quick, one more time. You fellas that like to say the reset accounts. And there's the other example I showed on ES, and then NASDAQ. Yeah, NASDAQ's today. So NASDAQ here. What are you going to say when I win the Robbins Cup next year? Oh, you rigged it. It's rigged. It's all rigged. He paid his way. Anyway, there's today's example. So this was a rushed job because I had very little time. But when you know what you're doing, when you really know what you're doing and you author this shit, you can find it. But it's always going to be on a delivery schedule based around time. Okay, time is going to be the important factor, because the market will start spooling for inefficiencies or the liquidity above or below the marketplace. Anything else you add to that is a religion. It's all it is. And I don't mean to be disrespectful. I don't mean to be condescending to anyone, but I guarantee you, if you strip your trading down to what I'm saying to you right here, only focus on where the stops are, only focus on inefficiencies, and where the market's likely to draw. That's 3 pillars. Those 3 pillars are the basis of you finding consistency, profitability, and longevity in trading. You will not have 100% strike rate. You will lose trades, but you will know exactly why you shouldn't freak out if you do have a losing trade. You won't rush back in because you lost money and you got to get it back. If there's not a reason to get back in, you'll know. And you'll sit quietly and wait for the next day or trading session. That's confidence. That's control. It's self-control. It's being responsible. You're being a good steward of your money. And that's all characteristic of someone that's trying to run this as a business versus gambling and trying to play the lottery with it, because combines are cheap right now. And that's a stupid excuse to go in there and waste $50. That's dumb. You're paying $50 to try to do something, okay, or a couple $100 to do something that if you did it the right way, you could literally start in a new year, okay? I'm placing a challenge for you as a student. Listen, even if you don't trade with my shit here and you're profitable doing something else, wonderful. I would love to see this. Start a new fresh account, whether it's a live account or you pass a combine at some kind of funded account company, okay? Trade with no expectation of taking any money out. None. Don't take anything out. You have to only get paid at the end of the year. But you cannot trade more than one contract. Do you have the discipline to do that? Do you have the discipline to do one contract trade all year? You cannot take a paycheck until the end of next year. You have any idea how hard that is? But the patience that you forge with that and the responsibility, because you have to guard your only one-time withdrawal. You got to guard it all year long. I'm not saying you can't trade another account separate to that, but can you manage one account like that? You don't need to trade it every day, but you should trade it at least once a week. Trading one contract and letting it grow, and you have no impulse that I got to get a payout out of that. I got to get paid out of it. Or I got to trade it real big, or I got to trade with more than one contract. It's an exercise in building discipline and patience. Most of you will fail trying to do this because you can't do it. But the ones that try to do it, you'll gain a greater deal of self-responsibility, self-control, and patience. And you'll look at trading and you'll look at profitability and you'll look at managing equity from a different perspective that you can't have until you do it. And then the following year, you do the same thing, but you let your equity dictate how many contracts you can trade, but do the same thing, one payout in the year. Are you going to take crazy fucking risks if that's the only thing you're going to submit to and you really stick to it? No, you're not. Not if you're trading like a business, you ain't. So I set that up for you as a challenge, because for the people that don't want to join the Robbins Cup, grow one account all year long. Can you do that? Because that's what I'm doing next year. I'm only at one payout at the end of the year, and my hands are going to hold that trophy, and I'm going to say, I fucking told you so. Do I need to do it? Nope. Do I want to do it? You're fucking right I do. I want to shove it up your fucking asses. Everybody that's ever talked shit, I'm going to feed it to you. Ass ended. I'm going to have fun doing it. So hopefully you learned something today. Hopefully you had some new insights shared with you. I broke down a lot of stuff that would have been just too good for a book, and not really in a way where I could articulate it well enough, I think, in a book. Showing it to you over a chart, showing it to you with execution, where it was, why it was, what I would have done differently, why it's performing the way it's performing, what it's reaching for, all those things. Okay. Seeing it in a static chart with a couple paragraphs isn't the same as seeing it explained dynamically like this, where you have real-time price action. Everything has to pan out or it's a failure, right? It has to go to those levels or I'm wrong, right? Well, that doesn't equate to profitability or unprofitability. You have to find that little area in between that, where you're right or wrong, and find your ability to be profitable. That is possible. That is what every professional trader strives for. They're not out here telling you that. They're not out here giving a shit whether you make money or not. They're out there minding their own damn business. And what they're doing is focusing on how they can put more coin in their pocket. That's it. They don't care about how many likes they get. They don't know how many people love them, give them clout, mention their name. They're out here simply trying to do better than they did the day before, make more money than they did last year, and hold on to what they have. And stay within a model that keeps them balanced, where they're not emotionally freaking out. They're not fearful. They're not second guessing themselves. They know exactly when they're going to do something, why they're going to do it, and they know why they're sitting still and when they're not going to take a trade. And they're comfortable with that. When you have a model, when you have a process that controls when and when you can't take a trade, you will never feel anxiety about getting in a trade that isn't really there. But you're fighting that. You're resisting that by trying to, give in to your impulses about, I need to take a trade. And if you're prone to be like that, the worst thing you can do is hang around other people that are supposedly taking live trades or actively trying to do so, because that peer pressure is going to push you right into something that you aren't really equipped to do or shouldn't do. And what do I mean by that? Hanging out on other live streamers. If you have poor discipline, don't go there. Watch it after the fact. I'm not saying don't watch other YouTubers. I'm saying you have to be responsible, just like an alcoholic. If you know you can't control yourself around the bar scene, don't go. Hang around those friends when they're not at that scene, that location where it's available to you. Until you build a discipline, until you build the personal responsibility that holds you to this measure of expectation that you're not allowed to do these things. And some of you don't like that language. No, you're not going to tell me what the fuck I'm going to do. Well, I get it. I understand. I'm built that way. But do you want to succeed? Do you want to have a long-term career at this and not just a flash in the pan lottery win? There's a lot of people that have had payouts one time and disappeared. My own son has had that 2 times. He got 2 payouts. And now because of life, his ex-girlfriend, that's causing him a huge barrier. He's depressed. All he cares about is as long as he can get through his workday. He's worrying about the new guy she's with because she went to college. Well, guess what? That's the real world. That's the real world. How are you going to deal with that? That's not in books. Course sellers aren't telling you that shit. They're only giving you the sugar high. I'm telling you, you have no idea what you're stepping into and how much it takes to manage all of this. And you're asking for, give me the bias and I'll figure it out the rest. No, you're bullshit. You're bullshit. You're going to know when you first try to do this that there's a whole lot more to it. And when you feel it, you're going to try to pretend it isn't like that. It's just, you're just scared and you're too new. No, it's you really felt the reality of it all. That's exactly what this is like. So you have to do a lot to manage all those things. And once you're able to do that, once you're able to manage yourself, to keep yourself from derailing yourself, and you're able to stick to a model, even if it doesn't give you a profitable trade 2-3 times a week, you don't throw the model away. You associate the executions with your own error. And that's uncomfortable. But that's the reality, because no one put you in that trade but you. I didn't. The people in those chat rooms you're hanging around with, the book author, the video that you watched, the tweet. the Facebook, the Instagram alert, none of those things put you in trade. You did. Always you. And if it doesn't pan out, you own that. It's your responsibility to be able to work past that. If it's a loss, eat it. It's good medicine. You'll learn from that. You're not going to learn anything from winning trades. You're not going to learn shit from that, except for ego and pride. And they are going to introduce more complexities in trading than anything else. I know this intimately. I tried to pretend that my losing trades were to be ignored. Don't spend no time with that. You know, it was them guys got me. And then I had to figure out what those guys are doing and why I keep falling victim to it. And when I would fall victim to it, I said, okay, what did I do wrong? See the difference there? It's a paradigm shift. I'm being responsible. What did I do as the trader wrong there? Most people today in our society don't want to admit they're wrong about anything. It's an uncomfortable position to be in because social media has trained us to be what? Judgmental of everyone. Oh, you did that wrong. Oh, look at you. Okay, what have you fucked up on in the last 24 hours? Oh, go. It's none of your business. Block. But that's the state of the world right now, and we're in this social climate right now, and there's so many people coming into our industry trying to believe that they're going to walk out here and it's going to be cakewalk, and they're going to start making all kinds of money. And it's going to be easy for them, and they're going to win on their first time, their first attempt. They're going to be successful. They actually believe this shit. And I'm promising you that it is not going to happen like that. Even if I trained you personally, you're still going to have adversities. You're still going to lose. You won't be able to be comfortable taking that first loss. You won't be able to. Unless you warm up to the idea that that's part of it. That's part of it. Losing, making it back, losing more than you lost the last time. Now you have a lower drawdown. Okay, nothing's changed, but I have to reduce my risk and accept the fact that it's going to take me a little bit longer to recoup this. Nothing's changing model-wise. You're just lowering your risk and you're lowering your frequency of trade and raising the higher time frame level that you're trading on. Oh, there you go. That's something for a book. But now you have homework. So anyway, my stomach is telling me I need to grab something to eat. And I had a lot of fun hanging out with y'all today. Hopefully that you've found something useful and insightful. And if you didn't, I apologize. I tried really hard to give you something that would be useful to you. But I can't please everyone, right? If you like what you've seen today and learned something, give me a thumbs up. If not, I don't give a shit. Until I talk to you next time, be safe.